rates and not just the 2024 debate?
Not quite yet, because I think if we were, we might be looking forward to a little bit more of an impact on high rates on the US economy, because there's very few signs of that so far. And it's that which will ultimately turn the dollar around. Until that happens, until you see signs that the economy is really weakening and that the Fed has to respond, it's very difficult to change the current momentum.
Have you got a date on your calendar when you think we might start having that conversation?
Well, it's obviously been premature so far, hasn't it? I think there were a lot of calls last year, a lot of people expecting the US to hit recession by now, and clearly here we are.
You haven't really changed your view on the dollar, and you actually see weakness ahead. How do you push against what we've seen, basically, which is a one-way freight train of dollar strength on the heels of better-than-expected economic data, hotter-than-expected inflation data, and frankly, even Fed officials who are changing their communication?
So I think the important thing is over what time horizon and to what extent. You know, my year-end call for euro-dollar is 108, so obviously higher than where we are today. But that's a call I've had since September of last year, when I think the whole world was looking for 115 to 120. It's more about where we are in terms of the range. For me, the range 106, 110, maybe we go a little bit below. But as we get down there, I do think there's good interest on the part of European hedgers to buy and lock in euro-dollar at current levels. And that kind of naturally limits the decline.
What's the trigger here? Because right now it seems like the data is coming out much weaker in Europe on a whole host of different metrics, including inflation. And then what you end up seeing is this feeling that the U.S. might not be able to cut rates until December at the earliest. So what's the trigger to really get to those levels that you were expecting last September?
Yeah. So I think the interesting thing is that even though we've effectively repriced the Fed, you know, think where we were at the start of the year and how many cuts people were calling for. And, you know, back then, I think we spoke in January, we were very much not in that camp. You know, we were looking for the dollar to outperform on the back of a repricing of the Fed. But given where we are now, and given how we're still pricing in a lot of easing for the ECB, it's interesting that we've only been able to get down to a 106 handle. And I think that in itself is telling, you know, the real repricing of rates in the US versus Europe, and yet we're just, you know, 3 to 4 big figures lower.
We started this segment with John quoting some of your note. You're saying most investors expect a Trump victory would be dollar positive. What would a Biden second term then mean in relationship to the dollar?
So I think a lot of people expect a Biden or a Trump victory to be fiscally supportive. You know, the reality is that it's hard to picture any political party at the moment in the US delivering fiscal tightening, and a lot less if you have a divided Congress. But from the point of view of a Biden second term, you know, it's a known quantity for a lot of investors. A Trump victory is interesting because there are actually split views. You know, I wrote that note a couple of weeks ago before being on the road for 2 weeks, and that's definitely the view in Europe. Interestingly, in North America, I found a lot more people willing to contemplate Trump being dollar negative.
Why so?
So 2 main parts to it. One is the pressure he may exert on the Fed to be a lot more dovish. And the second is that twin deficit story that I referred to in my note. You know, a lot of people keep coming back to this idea that at some point it's going to turn into a big dollar downward story.
When you say Trump dovish on the Fed, doesn't that actually match up with what potentially we might see from the Fed if they hold off on cuts this year? It'll have to be a 2025 story.
Will it, though? You know, it depends how much we're getting in the way of fiscal support from the government. So you have to expect at some point that the Fed is going to be cutting rates. You know, it's impossible to believe they're going to hold rates at these levels forever. But the timing question is a big one, because everybody was looking for the cuts to come this year, or a lot of people were looking for that, and here we are, right? So yes, it does seem more likely to come in 25, but the question is to what extent.
What do you think explains the US-European distinction? You mentioned 2 very different perspectives, one European, one US. What do you think explains that?
I think a lot of that might be the fear within Europe on the part of, you know, what tariffs mean for Europe, what tariffs mean for trade with the US. And also there's a bias. I mean, as you know, John, in the UK, we always tend to think of a downward trajectory for the pound.
Of course, always. It's sort of a permanent mindset. Elsa, I think what you said, though, sort of brought back memories of a conversation we had with Neil Kashkari around this table of the Minneapolis Fed, when we said, is this market worried about the US deficit? And he pointed to the FX market as a reason to say, nothing to see here, no worries at all. If we were worried about the deficit, we'd be selling the US dollar. You said there's a decent chance that maybe that story might change in the next 12 months.
It's hard to imagine in the next 12 months, because for me, it all comes down to sector financial balances, and in particular what the private sector is doing. As things stand, a good chunk of the US budget deficit is financed domestically. And as long as that's the case, you're not relying as much of the kindness of foreigners to plug that gap.
That said, and this I thought was fascinating, Seth Carpenter over at Morgan Stanley over the weekend, he came out and said, basically the stock of government debt is still repricing to the generally higher level of nominal rates after a decade of low negative rates. This was in reference to developed market sovereign debt. That repricing will lead to an inflection point where debt servicing costs start to accelerate. Doesn't that worry you if 2025 is not a story of cuts like so many people expect?
At some point, that will very much matter. You know, debt trajectory can be absolutely worrying. But at the same time, you've got to bear in mind that we've been here, so, you know, we've had this conversation around Japan so many times before, right? And it never plays out. And why does it not play out? Because actually, you're in an environment where domestic investors are very willing to finance it at the right yield. And at some point, the economy does slow down and the Fed cuts rates.
Domestic investors meaning the Bank of Japan. That's what I think. I'm just saying, theoretically.
Alistair, this was great. Thanks for being with us. Alistair Linios there of RBC Capital Markets, breaking down the dollar story. Dollar yen right now, 154.76. Lots of talk, conversation expected about supply this week. Lisa's been through the numbers already. Worth going through them again. $30 billion of two-year notes coming tomorrow. After that, $70 billion of five-year notes. And following that, we'll get $44 billion of seven-year notes. So a lot through the front end and into the belly of the curve. Coming up next in the second hour of Bloomberg Surveillance, we'll catch up with Bob Michael of JP Morgan Asset Management. We'll speak to Bloomberg's Jack Fitzpatrick and Alex Webb. And we'll catch up with Mandeep Singh of Bloomberg Intelligence with some big tech earnings on deck. Equity futures on the S&P 500. We are positive here by 0.5%. Live from New York City, kicking off a brand new trading week. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
trade the tepid 20s, and we're more in the roaring 20s camp.
We have growth, yes, slower growth, but growth overall. People are concerned that we're not going to see the growth expectations that maybe were anticipated. So there's a lot of pressure on a handful of stocks.
Top line should hold in there given the strong economy above trend growth.
I don't think it's going to turn out to be the tepid 20s. I still think the most likely scenario is actually the roaring 2020s.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Last week was a weird week. Market participants seemed more constructive about the economy and financial markets than policymakers did. Usually the other way around.
Yeah, well, and who gets it right? That's my question.
Well, that's a different question.
How often is it a counter indicator when we hear gloom and doom from some of the policymakers?
Live from New York City this morning. Good morning to you all. Your trading week begins right now. Equity futures positive by 0.5%. Let's go straight to the calendar again and talk about tech earnings this week. Big four. It's Tesla first, out of the gate tomorrow, then on to Meta on Wednesday, then Microsoft and Google on Thursday, then Bramo, it's into next week, Amazon, Apple, and into May, NVIDIA.
And frankly, it comes at a really important inflection point, and we've been hearing this time and time again. Basically, you've seen losses, the biggest weekly loss for the Mag 7 going back to November of 2022 at a time where maybe, just maybe, the AI adoption isn't happening as quickly and in as robust a manner as many people had expected.
The pain is real. We had a 10% move on NVIDIA on Friday. We've had a 40% move lower year to date for Tesla. Tesla in focus, I think, for so many of you at home. AMH, another round of price cuts going into the earnings release tomorrow after the bout.
As well as on the heels of layoffs. And I was just looking at Dan Ives' note he put out before this earnings. He said it's the moment of truth arrived for Elon Musk. And he's basically saying if Musk is flippant again on the call and there's no adult in the room with no answers, darker days will be ahead for this company.
All right, so I want to see if he comes out and doesn't have that. Dan Ives, is he going to come in a suit, in a black suit?
Hey, he promised, right?
He promised. Is he going to get bearish on this name? Is he going to not say buy anymore? Let's see.
It's been the moment of truth for a while for that name.
Correct.
And Dan Ives over at Wedbush. That stock, that name is down about 3% in the pre-market right now. Great guest alongside us, so let's get straight to the price action. Equity futures on the S&P 500 just about positive by 0.5%. In the bond market, the scores look like this, beginning with a 10-year Treasury yield higher by 3 or 4 basis points now, approaching 470 all over again at 465.79. Lisa, you mentioned it in the previous hour, no Fed speak, quiet period, Fed decision next week. What did we learn last week from Fed officials?
Frankly, the fact that John Williams of the New York Fed came out and talked about the potential of even hiking rates if the data warranted it was a massive shift. You know, honestly, over the weekend, again, there was so much focus on communication failures by this Federal Reserve, and a need to shift the paradigm, maybe come up with some sort of scenario analysis as a way to give people a sense of how they would respond to specific developments, as a way to better communicate to markets what they foresee.
2-year really close to 5% at the moment, 499.71. Coming up this hour, Bob Michael of JP Morgan Asset Management ahead of inflation data later on this week. We'll catch up with Bloomberg's Alex Webb as Tesla delivers another round of price cuts, and Mandeep Singh of Bloomberg Intelligence previewing Mag 7 earnings. We begin with our top story, nowhere to hide. Stocks on a 6-day losing streak and bond yields climbing towards the highs of the year. Bob Michael of JP Morgan Asset Management writing this: we are hoping there is a further washout of markets into month end. It's been overdue and will allow an opportunity for money to come in from the sidelines. Bob is on the sidelines of the show right now. Bob, good morning to you.
Happy to be here.
Hey, it's good to see you and good to catch up. Lisa said it. Fed officials wondering out loud, are we restrictive enough? Do you think they are?
Yeah, I think the narrative, how it's moved to rate hikes, is interesting to me, because if that's true, you're effectively setting a new indoor record for Fed policy. You go back and say, if they hike rates again, they will never have cut rates. So what's the longest distance of time from one rate hike to another? We know what that is. It was 2015 to 2016. It was 12 months. I don't think any of us are calling for a rate hike in July. So if they hike any time after July, then it's another new record for distance of time from one rate hike to another. It seems implausible. And then I go back to something else. We look at the summary of economic projections, the nefarious dot plot, the highest dot ever for neutral policy, the median was 4.25%. And then if you get to the extremes, it was 4.5%. That's 2012. So over the last 12 years, no one on the Fed has ever believed that rates had to be higher than 4.25%, maybe 4.5%. as a long-term neutral rate. And here we are, 5.25%, 5.5%. I put those things together. I can't really believe that we're going to see anything approaching a rate hike over the next year.
You've been constructive for a while. Last time you sat in that chair, I think you said this is the most bullish we've been since the mid-2000s. Is that still the case?
Yeah, very much so. The more we look at this, the more we see this playing out like 1995, which is the one soft landing anybody could have lived through and worked through. And I remember that like it was yesterday, because the first quarter of 95, everyone only saw demons. You had U.S. Steel default, you had the tequila crisis, you had Orange County default, you had problems with the securitized markets. I think at that point, GE had bought Kidder and was solving for that by liquidating it. So lots of problems. Nonetheless, we had a soft landing. The Fed came in July and started cutting rates. They did 75 basis point in rate cuts, and then they took 25 of that back a year later. The markets did great from 95 to 98. And by the way, inflation 2.5% to 3% during that period. So you can live with slightly higher inflation and a slightly higher Fed funds rate.
So you think the Fed's still going to cut 3 times this year?
Not so much today. I don't think that.
So
not so much.
So how
today.
much would they have to cut to continue to feel bullish and the most optimistic that you felt going back 2 decades?
So here's what I struggle. I gave the very elaborate narrative on how rate hikes can't be possible because it would be a new record. If they came back and cut at year end, that's another new record. So no matter what they do, they're going to set a record, because the longest distance of time from last hike to first cut was 2006-07 in there. It was 15 months. So you're looking at a record one way or another, so we're in uncharted space. I think the Fed wants to take the edge off of things. There are still frailties out there. You've had a 525 basis point rate hike. It's created a vulnerability in the system. You're seeing it in the consumer through housing. Housing affordability is the lowest on record. You're seeing it in the ongoing reconsolidation of the commercial property market with office buildings. They're trading at 60 to 80% below their original appraisal. And you're looking at C&I loans, you're looking at businesses that are funding themselves at 11, 12%, and a few years ago were funding themselves at 5%. So that weakness is there. I think it's slowing things down. It's slowing things down a lot more slowly than we anticipated, but I think we'll get there towards year end.
Just to give a sense of how much conviction you have, how aggressively are you buying right now as we do get the sell-off in bonds?
So I'm trying to hang on to all my fingers and toes and keep my discipline into month end. This feels like a real month-end washout. Somewhere around this time in the month, when you have those, the third week, you get a little bit of buying, and then everyone gives up the ghost into month-end. So I'm going to wait and see what happens going into Friday and Monday. There's some big data coming out. You not only have PCE, you have the Bank of Japan. I think you also still have a lot of investors wanting to take profits, or a lot of momentum investors yet to cash out. So we're really close. We're really looking at levels both in government bonds, more importantly in credit, and we feel this is a pretty good opportunity to get in.
That's our next question. The washout where? You're looking for it more in credit than you are in treasuries?
I'm hoping for it in credit. I'm hoping that we can push high yield back to 400 basis points over. I think that's too far. Can we get to like 350, 360? Absolutely. I'm a buyer in there. Corporate credit, we've already started to buy because it's mostly the risk-free rate in there, and that's had a pretty good backup. And treasuries, yeah, we'll see how this next round of fundings go, and we'll be in there buying.
Are you worried about the auctions at all? We'll talk about that a little bit more, a little bit later. Lisa's been talking about the numbers, some record issuance on some maturities. Any concerns there whatsoever?
No, not at all.
So why wouldn't you be buying now? What are you waiting for?
I think, so I'm not concerned about the auctions from a longer-term structural budget deficit, fiscal policy, because I think it does get spent. It gets used in the economy, and it generates revenue which the Treasury collects. So that doesn't bother me, and I think we've shown that it's sustainable, and the entire yield curve is trading below Fed funds. I think this is a month where people just want to get out of the way and see what happens. I want to see where things settle. There's no advantage to buying the day before 3 big auctions instead of the day after.
You know, I was struck by a Bank of America credit investor survey that came out in the past couple of days, and they said that the investors' #1 concern was inflation. You don't seem as concerned about inflation. The #2 biggest concern was central bank policy error, at a time where some people are saying that the policy error already happened at the end of last year with the initial pivot into talking about rate cuts. What do you think the biggest potential central bank policy error could be through the remainder of this year?
That they do anything, that maybe they should just sit on their hands and see how things play out. I don't know. I think there's nothing they can do wrong at this point in time other than hike rates or be too hawkish. I don't know that the pivot in December changed things from what we're seeing. Corporate profitability looks good. The consumer looks pretty stable. Inflation hasn't moderated at the rate we've wanted, but you know what? It's less than half of where it was a couple years ago. I think we're in a pretty good spot, and I can understand why the Fed wants to wait for a couple more quarters and see how things play out.
Bob Michael of JP Morgan Asset Management. Bob, you're going to be sticking with us, I'm pleased to say. If you are just joining us, the 2-year at the moment, basically at 5%, 4.99. Very briefly, with a 5 handle earlier this morning on a 10-year up by 3 or 4 basis points, 4.66. Let's get you an update on stories elsewhere. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Israel's military intelligence chief has resigned, citing security failures that led to the October 7th attack carried out by Hamas terrorists. The IDF confirms that its head of the military intelligence, Ahron Haliva, has stepped down after 2.5 years in the role. Haliva said, quote, "The intelligence division under my command did not live up to the task that we were entrusted with." Protests have been growing in Israel in the recent weeks, calling for Prime Minister Benjamin Netanyahu and his cabinet to take responsibility for the attacks and resign. TSMC options traders are preparing for a continued rout. Put volume on U.S. ADRs climbed to the highest since January. Shares have fallen over the past 6 sessions, erasing over $100 billion in market value. An NVIDIA put options also surged to its highest since 2017 on Friday. Los Angeles Dodgers star Shohei Ohtani broke the record for the most home runs by a Japanese-born MLB player. Ohtani's home run in Sunday's win over the New York Mets was his 176th in his 7th season in the league. Now, he should have plenty more opportunities to extend his record. Ohtani is still in the first year of a 10-year, $700 million deal with the Dodgers. And that's your Bloomberg Brief. John.
Crazy numbers. Danny, thank you. Up next on the program, the foreign aid bill heads to the Senate.
Well, the aid package certainly passes. On TikTok, you know, I don't think, honestly, we know yet.
We'll have that conversation next, live from New York City this morning. Good morning.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the program. Stocks are positive, negative every single day last week. We're bouncing back by 0.5% on the S&P 500. Yields are pushing higher again. 466 on a 10-year. The 2-year essentially at 5%, up a single basis point on the session this morning. Under surveillance, the foreign aid bill heading to the Senate.
The aid package certainly passes. Ukraine, Israel, the Indo-Pacific, read Taiwan. There's also an awful lot of sanctions and foreign policy matters that passed on TikTok. My instinct is that the wave kind of washes over the people who want that more nuanced approach, and we get right into the full ban. But that's very much a live ball in the Senate.
Here's the latest. A Senate vote expected tomorrow on $95 billion in foreign aid for Ukraine, Israel and Taiwan after the bill cleared the House. The House also passing a bill that would force Chinese-controlled ByteDance to divest from TikTok or face a ban in the United States. Joining us now is Bloomberg's Jack Fitzpatrick. Jack, let's talk about what you're looking for this week.
There's this one big thing in the Senate. All four of those measures that the House passed were actually packaged together. So there's one bill that the Senate has to work on. The Senate wasn't even supposed to be in town this week, but they're staying for one major passage vote. It's not entirely clear how much it can be slowed down, but there were some procedural maneuvers to make sure this isn't going to take too long. The first vote happens tomorrow. The second vote that actually passes all of these measures, assuming they do pass it, could be late tomorrow, might stretch into Wednesday. But one major thing on the to-do list in the Senate for all the foreign aid money, as well as the TikTok measure and the sanctions that are all packaged into one measure in the Senate.
$100 billion worth, nearly. Jack, when you look at all of this, so what kind of hurdles can we see? What do you think it will be? Will it be on some of the provisions like sanctions or TikTok, or actually on some of that money, that aid that's going to Taiwan, Israel, and Ukraine?
I mean, it's a matter of politics now because all the provisions passed with more than 300 votes in the House. If there were a holdup, the closest vote was on Ukraine aid, but the Senate has already passed a separate Ukraine aid measure that didn't make it through the House. So it does appear to have a glide path in terms of the legislation becoming law. The questions that remain are, what does that mean for Mike Johnson? What does that mean for a potential motion to vacate the chair? But also, what position does it put Republicans in heading toward the election? The political questions are where there's more uncertainty around where Republicans stand and where they're going in the future with regard to foreign aid. But this particular package looks very, very strong going into the Senate.
Okay, so let's talk about some of the politics involved. Could you see a future where Hakeem Jeffries comes to the defense of Speaker Johnson?
I don't think Hakeem Jeffries himself has to, but he has said that there are a significant number of Democrats who don't want to see the speaker lose his position over Ukraine aid. Now, they don't even have to vote for Johnson if there's a motion to vacate. They could decline to cast a vote, which would then lower the threshold that Johnson needs in terms of the number of Republican votes to stay in power. It inevitably would be probably a fairly close vote, but there are a number of centrist Democrats who have made it clear they're not interested in a speaker getting kicked out for allowing a bipartisan vote on the Ukraine measure, even if Democratic leadership doesn't really want their fingerprints all over that.
And Jack, taking a step back, a lot of people are looking for what the signal is from this vote. The idea that a lot of people, particularly on the far right, were pretty much hardliners when it came to additional spending. And now you have the potential passage, maybe through the Senate, of additional aid to Ukraine, additional aid to Israel, and as well as this TikTok bill. El Salinas of RBC Capital earlier was saying whoever wins the election in November is going to be fiscally supportive. Does this represent a willingness by Congress to back that fiscally supportive type of feeling from either of the candidates who are running for president?
I think there are a lot of variables still that go into that, so it might be a little, I mean, first of all, there's not going to be massive legislating and massive changes of direction in fiscal policy because Congress struggles to do big things. There are still questions about the degree to which the tax cuts from 2017 are extended when they come up in 2025. There is a debt limit deadline. Technically, it's the suspension lifts in January, but the extraordinary measures can bump that back. If Republicans still have a foothold in either chamber of Congress and Biden wins re-election, they would want to take a pretty fiscally conservative approach. They probably wouldn't if Trump wins. There are a lot of variables there. This doesn't necessarily show a willingness to spend a ton of money. I would point out most House Republicans voted against the Ukraine aid measure, which is part of why it's politically dicey for Johnson. So there are a lot of questions still unanswered about what the next Congress would look like after the election in terms of fiscal policy. And I'm not sure we can learn that much from this one, which was a bipartisan coalition action rather than a clear message of policy, especially from Republicans.
Whoever wins, I'm sure we're going to have a ton of fun in 25. Jack, thank you, sir. Jack Fitzpatrick there in Washington, D.C. Bob Michael with us in New York for some final thoughts. Bob, how do you explain how uncomfortable policymakers are with geopolitics and how seemingly comfortable market participants are with geopolitics? How do you explain the difference?
Because we've lived with geopolitics for a long time now. Unfortunately, we're in the third year of Russia, Ukraine. You learn to put it to the side. There's the initial shock, and these are the markets. They're dispassionate. They try to move on, process the data, and the data is glaring. It's right there. Corporate profitability looks good. Our analysts talk to businesses. They're talking about a pickup over the next year. You look at household. Yeah, they put more on their credit cards, but they're fully employed and they've got positive real wages. Those are the positive things in the market. And then there's a lot of cash on the side. You've got $6 trillion in money market funds. And I'm going to tell you why you never have to look at the Senior Loan Officer Survey again.
Please.
If you look at CNI
I enjoyed how you looked at Bramo when you said that.
I know where this is going to go.
Carry on,
Excuse me. Lisa,
yes.
if you look at the book of business for CNI loans in the U.S., it's either side of $3 trillion. It's some estimates of 2.8, some of 3.1. What's the size of private credit? 1.7 trillion. There's a non-bank lender out there. So while the bank's senior loan officer surveys were showing a tightening in credit conditions, something almost 2/3 the size of the banking system was looking for every opportunity to extend credit into the system. That market is still there. There's still a lot of cash going into it. That's a pretty nice tailwind to the economy.
As someone once said, okay, let's rip up the script. Going back to your thesis to buy bonds, all of this speaks to a no landing scenario. If you don't have something that's particularly restrictive, if you have credit that's easily available, if you have fiscal spending that's continuing to support certain aspects of the environment, of the economy, why is inflation going to come lower in a fully employed United States where people are spending on Tide Pods at a pretty escalating pace?
We've landed. We've come from very high levels of unemployment. We came from some sort of, double-digit growth in 2021 down to something that's in the, 2.5% real. You've got inflation that's not 7, 9, or 10%. You're looking at 2.5 to 3, maybe 3.5. So we've already landed from that very high level of growth and inflation that we were. What we're talking about is 95, where you start to grow at trend, and inflation may be a little bit above the 2% the central bank wants, but I don't think enough to worry the markets.
My takeaway, I just want to make sure I'm taking away the right message from you, because I'll repeat this for the rest of the week. You think this is a stable equilibrium where we are right now, where inflation is growth, where rates are?
I think for now it is. I do think, I go back to one of my original comments, which we never saw anyone on the Fed in the last 12 years throw out 5+% as the long-term neutral. So it's restrictive, it's slowing things down. At some point, they're going to have to come in, like they did in '95, and take rates down a little bit, maybe 50, 75 basis points to take the edge off of businesses and households. But it looks like it's a really good environment.
You think the long dot, and I've only got 30 seconds, might have a 4 handle once all is said and done?
I think over time, we'll go back to a 4 handle because there's a new demographic, and look at the millennials and either side of that. They're now in their 30s. They're the dominant earner, spender, saver.
Fascinating. Bob, this was great. It's good to see you.
Always a pleasure.
Thank you, sir. Bob Michael at JP Morgan Asset Management, and not a word on Liverpool Football Club. That was like the appearance fee we promised. Coming up, Tesla shares on track for their 7th day of losses after delivering another round of price cuts. We're down by 3.6%. Bloomberg's Alex Webb up next.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Closing below 5K on the S&P 500 for the first time since February. Equity futures attempting to bounce back by 0.5%. It's quite a run of losses on the S&P 500, coming off the back of its worst week all the way back to the bank intention of spring of last year. The run of losses is 6 consecutive days. That's the longest losing streak. It equals it, going all the way back to October 2022. The Nasdaq up by 0.6%. The Russell, the small caps, up by 0.5%. The focus, I think, for us, Bramo, this week is going to be the Nasdaq 100, given the weightings of these big tech names.
Given the fact that this is kind of the moment of truth, if you want to use Dan Ives' words, about whether they can deliver the earnings that can maybe prove a buying the dip type of moment. I think that Lori Calvasino really nailed it over the weekend. She said investor sentiment has taken a bit of a hit, but it's too early to say the pullback is over. Everyone said buy the dip. Unclear whether the dip has happened yet, if this is the dip or if the dip is more to come.
We just heard from a big bull.
Yes.
You know, like he was talking about being the biggest bull all the way going back, what, 20 years? Okay. Most bullish he's been since the mid-2000s, mid-90s. What did he say? There's a washout here. Wait. What's the wait? A few extra weeks.
Exactly. So basically someone who's bullish is still not buying at these levels because they're waiting to have more data come in to confirm that. What's that data going to be? It's going to be earnings. It's going to be PCE. And it's going to be what happens at the auctions and whether yields can keep on climbing. And
a Fed decision next Wednesday as well. Let's turn to the bond market. The 2-year through 5% once again, a little bit earlier this morning. On a 2-year right now, up a single basis point to 4.9993. On a 10-year up by 3 or 4 basis points to 4.6579. The last week has been a mix of solid data, jobless claims again, in and around 200K. And Fed officials starting to say the quiet part out loud. Perhaps we aren't restrictive enough.
And maybe, if the data warrants it, they're going to have to hike rates further. This led some, including Ben Bernanke, the former Fed chair, coming out over the past couple of weeks and saying they need to change their communication strategy. He talked about maybe you need scenario analysis. The dots are kind of useless. A lot of people feel that the dots are just basically a nice design, and that what they should be doing is talking about if we see inflation come up to this level, this is how we'll respond, rather than just sort of this, I don't know, let's see, we've got more data coming in. Let's look at, you know, the slews. Let's look at, I don't know.
Or not, apparently.
Or jolts. Yeah, I actually can never look at them again, evidently.
Yeah. Ben Bernanke, do you find that curious that the Bank of England turned to Bernanke to come up with a new communication regime when he was the one who, I wouldn't say was solely responsible, he had some help on the FOMC, Janet Yellen helped him too, responsible for leading this communication regime coming out of the great financial crisis?
I can't really wrap my head around it. I mean, it's a lot to sort of digest.
Why did we turn to Bernanke
odd. Maybe if you
I think it's because Yellen's tied up. I think maybe she was the first
We would have
choice.
turned to Yellen? Okay. That's where we are right now. That's the bond market. Let's talk about foreign exchange. This from Kit Jukes of SocGen. A pause to reflect, or maybe just to confuse us all. I'm with you, Kit. This is what Kit has to say on the euro. Our forecasts look for a fall below 105, but not to parity, which is hardly thrilling. So I'm hoping for surprises rather than expecting them. Because at the moment, Europe is just doing exactly what everyone expects it to do, which is not a great deal of things. And we're stuck between 106 and 107 at 106.39.
What El Salino said I thought was fascinating. The fact that we're not closer to parity tells you a lot, because what you've seen is, yeah, Europe doing Europe, right? But the U.S. doing U.S. and better than the U.S. has done it in the past. Basically, we're looking at the potential for no cuts this year. So why didn't we see a bigger move? And the fact that we have it makes her think, okay, maybe this is stability, the sort of equilibrium that we were just talking about.
Europe gonna Europe. Is that right? Is that the title of today's newsletter? Europe gonna Europe.
It's been a really confusing bunch of weeks. Could I just tell you, I think a lot of people are just like, you know, give us some conviction.
Yeah.
We got to sit here. I mean, look, even if you've got conviction or you're bullish, you're not buying. That's the tone of the morning.
The euro gonna Euro with negative 0.1%, 106.39. You've offended a lot of people, Bramo.
No, I haven't.
Under surveillance this morning, you haven't. Israel's military intelligence chief resigning over the failure to prevent the October 7th invasion by Hamas. It comes amid growing protests in Israel calling on Benjamin Netanyahu's government to take responsibility for the events in early October. Actually, over the weekend, MH, can we just say, you know, some quiet, no real big developments like we had in the previous week?
Absolutely. In terms of a calm at the moment, the end of this chapter we've seen potentially between Iran and Israel. But I will just say the Israeli people have been starving for some sort of recognition by the government that they were at fault for what happened on October 7th. And you're seeing it now with this resignation. Will the call stop for Netanyahu to step down? I'm not sure. You're seeing protests of tens of thousands of people that just haven't abated since that attack.
Brent crude right now, negative 0.6%, 86. 76 on Brent. Elsewhere, Commerce Secretary Gina Raimondo saying Huawei's latest phone shows China trails the US in chip technology. In an interview with 60 Minutes on CBS, Raimondo saying this: "We have the most sophisticated semiconductors in the world. China doesn't. We've out-innovated China."
But then Leslie Stahl says, you mean Taiwan. And then Gina Raimondo goes, fair. Because, yeah, the United States designs them, but 90% are made in Taiwan.
You remember that trip last summer, Raimondo going to China, and Huawei unveiled that phone. Is this the snapback? Is that what this is?
Well, not just unveiled that phone. What else did they do? They were spying on her. Remember, there was these leaks that they were getting into Secretary Gina Raimondo's emails, and she kind of took it as, well, they know my work here is important.
Are we surprised by that? Would you just expect to be spied on as a foreign leader landing in China? Wouldn't you expect that?
I'll give you an anecdote. I spoke with an executive who went there, who serves on different boards, who said that they use a burner phone and a burner laptop, and that's pretty much what everybody does when they go there because they know they're going to be spied on. It's basically protocol if you're an executive of any type when you go to China, which is incredibly surprising that she'd make herself vulnerable to that, given the fact that people do not bring their cell phones to China because of just that.
Yep, interesting exchange with the Commerce Secretary overnight. Let's pick it up on shares of Tesla, falling in the pre-market after the automaker cut prices on a range of models in the US, Europe and China. The move potentially sparking a new price war in China, with one automaker there already slashing prices on its models in response. It caps a busy few days for Tesla ahead of its earnings report tomorrow. The company also recently announcing it will reduce headcount by more than 10% globally. Bloomberg's Alex Webb joins us now for more. Alex, we get earnings tomorrow after the close. I just wonder how low or high this bar is for Elon Musk and co.
I think expectations are remarkably low given what we've seen at Tesla in recent weeks, but also compared to how high they were perhaps just a year ago. That does mean, actually, that any surprise to the upside is perhaps likely to be taken positively by the market. We've seen, huge increase in the number of sell ratings on the stock. The 12-month target price is very close to where the stock is right now. So it does mean that, actually, perhaps the bar isn't terribly high tomorrow.
Alex, when these price cuts started in the last year, there was a bullish way to frame this, that Tesla had the margins and they could put the squeeze on everybody else as they're trying to ramp up production and gain market share. Can we frame it quite as bullishly now?
I mean, it's very hard to do so, given that they have lost 4 percentage points of market share in that time frame. They're at about 10% market share in the first quarter of last year. They're at about 6% and a bit now. The challenge they have is that companies such as BYD, the more scale that they have, the easier it is for them to reach greater economies as a consequence. And that has very much been the BYD approach, to get into as many different segments as they possibly can, often at a quite low price point, which then means it's cheaper for them to, of course, produce the vehicles at all. It is an incredibly competitive space in China. And Tesla's timing was pretty inopportune. They expanded production capacity globally to something like 2 million units, just as demand for EVs started to decline. And what's more, you started to see the second-hand EVs come into the market. You see the massive price depreciation on those, which has sort of inversely turbocharged demand in the market. The people see the drop-off, they go, oh gosh, do I want to be exposing myself to that? And it makes the slowing down of the market even more drastic.
So a lot of pessimism around this name, especially as they have lost share in China, as you mentioned. How much could the robotaxi shift that?
It's hard to see how. The struggle that I see with this vehicle is, I'm not sure what the business model is, right? Is this just actually they're going to be selling when they talk about full self-driving, which is the name of their kind of superior cruise control product that they have, it is not full self-driving. Are they just going to be selling then a new version of self-driving to their customers? Or when they talk about a robotaxi, are they talking about a new business where you are putting fleets of robotaxis on the road? If it's the latter, I have no idea what investors are going to make of that or how they'll see the upside of that, because it's an incredibly expensive proposition. These vehicles, if they genuinely are full self-driving, will be costing well in excess of $100,000, one would assume. If you need to get 100,000 of them onto the streets of a city like New York, that's billions and billions of dollars. So I'll be fascinated to see the business case that he makes when this thing comes out.
Alex, what about a bet on a lower mass market car? What happened to the $25,000 Tesla that was supposed to be competitive?
Well, it certainly looks as though the experience in China has informed that. You know, it looks increasingly difficult to compete with the likes of BYD in that geography. You know, if you were a corporate strategist, you might well look at it and go, well, let's not even bother. Let's go for the bit that we really can own, which is the more premium segment where we can get the juicier margins. But even right now, they're struggling a little bit on that front. So it's something that investors had really been hoping for that next leg of growth, and for now, it doesn't look like it's going to be coming.
Alex, we're all fascinated with the China piece of this, and not just with this company, with another company that you follow closely, Apple. They'll be reporting next week. Do you see any crossover whatsoever between the struggles that Tesla is having and the struggles that Apple is having in that country?
I think there might be one note of comparability in that there is a rise in Chinese nationalism, essentially, that they should support their domestic brands. That is something that appears to be hitting Apple a bit at the moment. That you were talking about Huawei just a few minutes ago. Brands like Huawei, Xiaomi are experiencing a bit of an uplift in their home market. It is the Chinese brands in EVs that are also dominating. Lots of people saying that maybe when they start hitting Europe, that's when these companies really will reach a scale which will make it very, very hard for anyone to compete with.
Any pushback from the Europeans yet, Alex? We just got back from Washington, D.C., and everybody was talking about putting up the walls to Chinese EVs and just waiting for that decision. What's it sound like on the ground over on the continent?
It is quite a tense matter. We're going to see a Chinese car maker set up a factory in Italy. As things stand, that is going to happen. There's been a lot of criticism from other parts of the region because of that. But at the same time, if you want to meet your goals when it comes to climate change, you need to have more of these vehicles on the roads. At the moment, it's quite hard to import them from China. So producing them locally, the argument is then at least you're employing people locally, and it's good for the for the local economy in that sense. So it's clearly not an issue on which everybody agrees. There is increasing tension around this theme.
Tesla down 30% in just 3 months. Alex Webb, thank you, sir. Alex Webb there on Tesla, on Apple. Tesla reporting earnings after the close tomorrow, then on to Apple next week. Two big stock stories to break down, including that piece on China, just what is happening in the world's second largest economy. Let's give you an update on stories elsewhere. We can do that with your Bloomberg Brief. Here is Danny Berger. Hey, Danny.
Hey, John. The New York Stock Exchange is asking stakeholders on their thoughts about 24/7 trading, according to a report in the FT. The survey reportedly asked respondents whether there should be nonstop trading throughout the entirety of the week and how they would staff any overnight session. Verizon shares higher in the pre-market trade, up by about 1.5%. It beat on profit. It also had a boost in wireless subscribers, thanks to both price hikes and customers choosing premium plans. The CEO said that they are on track to meet guidance for the year. TikTok's future is looking more uncertain in the U.S. The House has passed a measure requiring TikTok's owner, ByteDance, to sell its stake in the social media firm. If it refuses, it might be banned in the U.S. Sources have told Bloomberg that ByteDance intends to fight the effort in court before considering a sale. The Senate is expected to vote on the measure tomorrow. That's your brief. John.
Danny, thank you. Lisa nailed it earlier this morning. They're going to drag this out and drag this out. They're going to say that the matter's concluded going into the election and nothing's going to be concluded.
Basically, this is how you avoid an issue that could potentially alienate a younger demographic that use TikTok. Yes, we're aware of the concerns. We're on it. We're going to do something, but it won't affect you in any way, shape, or form in any time of the foreseeable future. So therefore, out of sight, out of mind.
Younger demographic for the Democrats, but potentially a key donor for the Republicans.
Big focus down in D.C. Up next on the program, earnings season ramping up.
There's a lot of pressure on a handful of stocks. We know that. We'll see the earnings come through on those. But the momentum isn't what's driving us anymore, and I think that's key.
4 of the Mag 7 reporting earnings this week. Live from New York City, this is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time, and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly. We're Monzo. Give us a go.
See? I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
NVIDIA has delivered that for the last 2 times. This time around, it's not going to be, I think, NVIDIA. It'll probably be Microsoft, because they are the ones who are actually deploying AI. When you think about, what are companies doing with all the GPUs? NVIDIA and Meta have the most GPU allocation, and we know Meta is using it internally. Microsoft is the one that's actually deploying it on the cloud, and that's what you want to see in the numbers.
What would you expect to see in the numbers later this week?
I mean, the Azure growth, last time around, they quantified it was around 400 to 500 basis point lift from AI. You want that lift to be higher than what they reported the last time around.
There has been a feeling in markets that maybe we got ahead of ourselves when it came to how quickly AI would be adopted and deployed, to your point. Do you expect to see that type of sentiment in Microsoft's earnings, and frankly, even in the likes of Apple's earnings, given the fact that they're trying to deploy it in some very specific ways?
Well, so Microsoft is uniquely positioned because, one, it's using a lot of its own CapEx to deploy AI, and then it's got consumer-facing products, whether it's your Copilot or, just how they're deploying it in search with OpenAI. I mean, basically what they're saying is, we will be the first ones to deploy OpenAI, and we also have the capacity with the GPUs for others to deploy. And that's a great value proposition if you think about, investors looking to play that AI theme, whereas NVIDIA is more, okay, everyone wants GPUs, they are in short supply, the pricing is high, but then it will normalize, and that's the risk they have.
Will this earnings season officially be the obituary on Magnificent Seven, on this concept that we can talk about this cohort in some sort of cohesive way, given the fact that they all face very different outcomes, very different outlooks, and frankly, a very different journey with their stock price?
Well, so I put them in 2 buckets. The consumer-facing ones, your Tesla and Apple, are the most exposed because, one, the device refresh will be slow, or your car refresh will be slow, and they don't have that enterprise exposure. I mean, you want to play companies that are exposed to this CapEx wave. Every large tech company right now is investing in CapEx, and they are beneficiaries of that CapEx spend. these companies are exposed to consumer, and you're not seeing that kind of lift, and that's where I think they probably will struggle with top-line growth.
Also, those two companies you pulled out, not just the exposure to the consumer, but also China. What are you expecting in terms of China eating at these earnings?
You're absolutely right. I mean, in the case of Apple, it's almost 15 to 20% revenue exposure. And it's the same for even NVIDIA. They have that kind of exposure where if something goes wrong geopolitically, you're going to lose that revenue stream. And that right now is a big risk for any large tech company being exposed to China revenue. It's a big risk, and the other ones don't have that.
Do you think the markets have really taken that on, have really ingrained that in their brain, that if there is a big geopolitical risk, there's massive downside to these companies?
Well, so I think some of it is embedded in the price. I would argue even the regulatory risk, like what goes on in Europe or what's happening here with the DOJ and the regulatory stuff, that's baked in somewhat because these companies can't acquire any other company right now. So that's embedded. But in terms of the overall China revenue going to zero, that's not embedded in the price. So clearly that is a risk.
Can you explain Friday's price action, which is probably the hardest question of this conversation? Why were we down 10% on NVIDIA on Friday? Just a casual $200 billion move lower.
It's a crowded trade. I mean, that if there's one trade that everyone has piled on, it's NVIDIA because it's the poster child for generative AI, and for a good reason. The problem is at $2 trillion market cap, a lot of that growth is embedded in the price. And look, NVIDIA isn't going to grow 50% for the next 5 years. That growth will taper, and I think that's why you see that kind of reaction.
Do you think we might see some signs of that later in May when they report?
Probably not for this quarter, given we are still supply constrained. I mean, with chips, it's all about when that supply-demand equation will normalize, and it hasn't normalized based on what TSMC has told us this quarter. So I would say this quarter will probably be fine.
If you thought that was a big sell-off, take a look at Super Microcomputer, which is essentially what some people are saying spurred it. Those shares lower by 23% after saying that they were going to have a date where they report earnings and they didn't give guidance. That was enough to tank the stocks. Does that give you a sense that maybe people want to sell, that maybe this actually gives you, tells you more about the sentiment and some of the fear that we already see in the market?
Yes, we are, and I'm not surprised if you go back in time with any secular trend. Because we are so early in the trend and you've already picked winners, you will see that nervousness and volatility around their stock because things don't go up in a straight line, especially when you are talking about 50, 60% growth. The law of large numbers has gotten to NVIDIA, not so much for Supermicro, but then at the end of the day, they attract a lot of competition. When your stock rip up like that, it's going to attract everyone to try to break that growth path that you have.
So I have to be honest, I'm a little bit distracted right now because you were talking about the two buckets of tech names. And it seems like we're looking at three right now, correct? We're looking at Microsoft, we're looking at Google, and we're looking at NVIDIA. So is there a new name or a new moniker? Because right now I think that we can actually say that the Magnificent Seven is dead.
Well, I don't know if it's dead because I think Alphabet for the longest time was perceived as the one which is going to get disrupted. And now the market is realizing, well, guess what? They are ahead when it comes to the generative AI wave, when it comes to developing their large language model, even their cloud growth will pick up. So clearly that perception is changing, and it's too early to write off Apple as well. I mean, they have a very sticky ecosystem. At the end of the day, it's about the ecosystem and how sticky your revenue is. And Apple, Alphabet, it's a very sticky business model.
Isn't that precisely what US officials are trying to disrupt? The Apple ecosystem. Are you saying they won't be successful?
Well, unless you just force them to open up the platform, which everyone is doing. Now they have to open the Apple App Store, and Google has to do the same on the Play Store. Well, guess what? That is somewhat eating into their take rates. And so if things happening along those lines where they can't even, have control on their software or have control on their hardware, then it will become a problem.
You mentioned something else as well, Mandeep, but maybe we should finish there. Google, changing perceptions. How have they done that? Because Gemini was a disaster. Talked about it around this table, about maybe putting ideology before facts. Do you think perceptions have changed in the last few months?
Absolutely. I mean, look at their market cap now. They were trading below NVIDIA for a while, and now they have caught up. And clearly, when it comes to Alphabet, everyone realizes how strong of a moat they have when it comes to data that feeds into search. A lot of the large language models have pre-trained data. When it comes to live searches, you have to use Google or Bing. and Google search is much better. So that's where everyone realizes LLM is not the solution. You need real-time search, and that's Google's still mode.
Big fan of Bing around this table, Mandeep. Mandeep Singh of Bloomberg Intelligence. Mandeep, thank you. Let's just go back to the Canada. I like what Mandeep did just then, separating some of these companies, the consumer-facing companies. Tesla, tomorrow after the bell. Apple, later on next week. Apple and Tesla facing headwinds with the consumer, and more specifically the Chinese consumer, for varying reasons.
They kind of have a number of different challenges. On one hand, you've got the Chinese consumer and the fact that they produce and they sell in China. They also have the idea of the super cycle with respect to smartphones and where we are in that, and the super cycle in electric vehicles and where we are in that. So that's another thing. And then there's this third thing that we heard nothing about, which is cooling investor demand, or cooling consumer demand. No one's talking about that. So is it cooling? Is it heating up? Very curious to see.
And you hear from some people and some investors saying Tesla and Apple both need to have a lower price target for a new, say, car or a new iPhone that could potentially then bring up this market share. Although Alex Webb said basically what happened in China won't make sense for Tesla. And also, they're leaning towards India. We've seen that happen with the Apple CEO. This week, Elon Musk was supposed to meet with the Indian Prime Minister, and because of all the bad news that's happened, he had to basically hit pause on that. But you can see both these companies are looking at India, potentially because they're losing out in China.
We're looking to Elon Musk. Tesla reporting after the bell tomorrow. 4 of the Mag 7 reporting this week. It's a big week for big tech. Coming up in the next hour, Michael O'Rourke of Jones Trading, EIB President Nadia Calvino, Lara Rain of FS Investments, and Bloomberg's Ed Ludlow. Now from New York City with equity futures near session highs, up by 0.6% and yields climbing 4 basis points. This is Bloomberg.
I'm part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger. But obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. So this is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
the Fed is going to keep rates higher for longer, and that puts more pressure on the economy.
I do believe that the monetary conditions are not tight.
Yes, we're probably going to have slightly higher inflation, and yes, we're going to have higher interest rates, but to us, that's not that bad a problem.
The economy has demonstrated that it can live with these interest rates.
Financial conditions have been tightening to some degree. Overall, the picture remains fairly positive.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Andrew Hoddenhorst, Citi, weight and PCE. You see what he did there?
Yeah, I did.
How long did Andrew work on that?
You know, we can have him on and ask him.
Oh,
Do you think it was
over
good?
the weekend.
Really?
Weight and PCE.
Oh, God.
Okay, PCE coming up on Friday. Tons of tech earnings in between. We've been through the calendar already this morning. Tons to talk about after 6 days of losses on the S&P 500, equaling the longest daily losing streak going back to October 2022. The good news, as Lisa has already said repeatedly this morning, no Fed speak. They're in a quiet period. We're going to count you down to the Fed decision next week. And Bramo, we go into that Fed decision with them wondering out loud, are we restrictive enough? And it's been interesting to see official after official ask themselves that question.
And what the potential response will be if they get the sense that maybe inflation is running too hot. I keep going back to this idea of scenario analysis and whether they give us some sense of, okay, is a hike on the table? What actually has to happen for that to be the case versus keeping rates where they are into 2025, which also would have a significant market implication.
Returning from Washington, D.C. with a big conversation in the nation's capital about U.S. exceptionalism, high interest rates, big deficits, sucking capital away from everybody else and producing a much stronger U.S. dollar. Heard complaint after complaint just last week.
Absolutely, and we saw this. Basically, the U.S. also tactically acknowledged that complaint, Jonathan, when Janet Yellen had that meeting with her counterparts from South Korea and Japan, that yes, the U.S. dollar is strong, and we understand potentially if you guys have to do something about it, because at the end of the day, it's their problem. At the same time we're talking about this, it's on the heels of, over the weekend, we're on track. Tomorrow, potentially, the Senate's going to pass yes for this. Nearly $100 billion, once again, coming out of the United States and going to foreign allies.
Just getting that confirmation. Andrew Hoddenhorst tomorrow morning, 6:45 Eastern Time. We'll ask him how long it takes to come up with a title. That's one to look for. Here's another one. Tomorrow after the bell, we'll hear from Tesla. Then earnings season starts to pick up with Meta, Microsoft, and Alphabet. Into next week, we'll hear from Amazon. Then we'll hear from Apple, then Nvidia later on in the month of May. I love what Mandeep Singh did of Bloomberg Intelligence. Look at the consumer-facing tech names like Tesla and Apple. They've got a long list of problems.
And they have to do with international issues with respect to China, but also maybe there'll be a read on just how much demand there is, how much consumer appetite there is to spend $1,500 on an iPhone. Because if you take a look at any Apple store, it looks like there's still quite a bit of appetite, at least in the United States. How much does a lack of demand elsewhere really matter? And EVs, I mean, that's its own ball of wax. I am curious about Dan Ives' view on Friday. He will be joining us, and we can see whether he comes in a suit.
Well, he says this is like the Cinderella moment for Tesla on this earnings call and for Elon Musk. He calls it make or break. But to your point, he's been saying that, and he's still over on this stock. He still thinks that there is a story to tell. I also like what Mandeep did about Microsoft. Felt like everyone's talking about the doom and gloom of Tesla. Microsoft, he says, is the only one that's really putting AI to work. And if this is a market fueled by this AI rally, well, let's see how Microsoft does. Tesla
down again in the pre-market this morning. Equity futures up by 0.6%. Here's the state of play for you. If you are just joining us, welcome. Yields are up by 4 basis points, 465.79 at the front end of the yield curve, taking out 5% briefly once again earlier on in the session. Right now, up by not even a basis point to about 4.99. In the FX market, the euro a little weaker, dollar stronger, 106.34 on that currency pair, negative by 0.2%. Coming up this hour, we'll catch up with Michael O'Rourke of Jones Trading on what he calls an inflection point for markets, European Investment Bank President Nadia Calvino on defense spending for Ukraine, and Laura Rame of FS Investments on why she sees the 10-year retesting 5%. We begin with our top story, hot US data pushing out rate cuts. The Fed's preferred inflation gauge due on Friday. Michael O'Rourke of Jones Trading saying this: financial markets are at an inflection point. The Fed's overestimation and overconfidence as to how restrictive policy is has fueled easy financial conditions and excessive risk-taking while fostering easing expectations. Michael joins us now for more. So, Michael, bearish. Fair to say based on that?
Yes, definitely fair to say. I mean, I think you've touched it. Even when you talk about that 10-year yield potentially going to 5%, right now for the past 3 weeks, the 10-year yield has been higher than the S&P 500 earnings yield. Even though the S&P 500 has corrected 6% over that time, that relationship has stayed the same because yields have continued to rise. And that just shows you have a risk-free instrument offering you a very attractive return versus risky instruments in equities that are pretty expensive.
Drawdown so far, 5% from the all-time highs of March. How much downside are you looking for?
I think there's a lot of potential. I'm not going to sit there and say, you know, I can't put a number on it because a lot of it's driven by financial conditions, right? We've had this easy financial condition environment that has basically fostered equity prices, fostered asset prices across the board. Even the Fed's financial stability report released on Friday talked about how equity valuations are high, historically high, how credit spreads are tight. But if that relationship between treasury yields and earnings yields, it's traditionally the equity, you know, the S&P 500 earnings yield over the 7 years prior to the pandemic was about average 340 basis points over treasury yields. Even to just get a third of that back, the S&P 500 would drop 20%. And that's the type of risk we're talking about here, that I'm not saying we're going right back to that relationship. It just gives you an idea of how expensive stocks are relative to bonds.
I love this. Everyone who comes on the show today seems to think we're at an inflection point. Bob Michael also seeing a potential inflection point, but in the opposite direction,
yes.
A potential opportunity to buy. Why is this inflection point, in your view, going to inflect more negatively?
Well, because, okay, you look at the earnings situation. We have earnings season coming up. We're talking about all the big earnings this week, right? Earnings this quarter is supposed to be basically sequentially flat versus Q4, almost flat year over year. The big bump in earnings is supposed to come in Q2, 3, and 4, where aggregate earnings are supposed to rise 16%. Now, analysts are forecasting a 16% earnings jump for those 3 quarters in a 5.375% Fed funds environment. You know, we're not getting the rate cuts we expected. We're not getting what the catalyst that should drive things in, you know, going forward in the economy. We've had an incredibly strong economy, and a lot of that is fiscal and monetary stimulus from the pandemic playing out over the past couple of years. So again, to expect that type of jump in earnings, it's pretty aggressive. And if you don't get that, then you realize how expensive this tape is.
And do you see this idea of a sell-off in stocks that comes along with an ongoing sell-off in bonds? Sort of something that continues the divergence that you were talking about with the 10-year Treasury yield being above the S&P 500 earnings yield? Yeah,
well, if you go back to the 90s and you know, probably the earlier 2000s, the old saying was, you know, stocks follow bonds, right? If treasury yields were coming down that big bond bull market, stocks rallied, right? Because they're competing with each other for assets, for investment assets. So now we're seeing treasury yields rise, and basically, which means bonds are going down, and stocks should be following bonds lower here from a price perspective to keep that earnings yield for the S&P 500 somewhat competitive with the risk-free instrument in treasuries. And we just haven't really seen that yet, except in the last 3 weeks we've seen this dip, but they've moved together.
Do any of these relationships still stand, or have we broken all of these?
No, well, so that's the interesting thing. If you go back to late 90s, the treasury yield was, the earnings, S&P 500 earnings yield was consistently lower than the treasury yield, but that was you know, during the Great Moderation as inflation was, you know, coming down, you know, for basically decades at that point, and bonds were just, you know, cautious, or investors were late to follow. This is the inverse situation where we're seeing inflation's more sticky. We're seeing a structurally different economy than we've seen from 2000 to 2020.
You say that the Fed policy does not need to change at this point, but communication does. What are they getting wrong when they're speaking to the market?
Well, I think they're just taking what they're seeing in front of them, and they're being overconfident in what they're seeing. So in 2021, the story was it's transitory, and we heard that for a year. When the Fed finally raised interest rates, core PC had actually peaked in February of 2022. The Fed raised rates in March, and they finally ended QE in March. They were late, and they were too confident for too long. So since last summer, we've heard policy is restrictive. But it hasn't been. In Q3, we put up a 5% GDP print. At that point, the Fed has to go back to themselves and say, we're missing something in this economy. And instead of doing that, they continue to say policy is restrictive. And they keep this estimate of the long-term Fed funds rate down at 2.5%, which is only a 50 basis point, real neutral rate. Whereas even the New York Fed's DSG model has it at 2%. So they're basically going off of a forecast that interest rates are going back to lower levels, or the market's taking their forecast. They don't actually even believe it anymore, and saying, oh, this is where we're going in the future, so we can keep equity valuations inflated a little bit higher.
We start hearing some Fed officials talk about whether or not they are actually restrictive, though. And Michelle Bowman last week said, we're restrictive, but we might not be sufficiently restrictive. What's the difference?
Oh, it's massive, because if you're underestimating or if you're overestimating how restrictive you are, then you're making a policy mistake, because policy is far looser than you believe it to be. So that is why, you know, for the past 3 quarters, if you include what this Q1 is going to look like, we've put up, I think we've averaged GDP of about 3.6%, which is double the Fed's long-term forecast of U.S. potential GDP. It's funny, Chairman Powell talks about the risks being imbalanced now. If you go back to pre-pandemic, when we had 1.8% core PCE, the Fed was willing to do anything to push inflation up to 2% and micromanage it there. Here we're at 2.8% PCE. We're talking about things being imbalanced. Meanwhile, the unemployment rate's 3.8%, which is 30 basis points lower than the Fed's long-term target of 4.1%. So we're still in an inflationary environment per the guidance they give, per their models, per their forecast. But they don't talk about like that. All they've talked about for the past 6 months is cutting rates until the past couple of weeks.
So why should I just buy stocks? There's no sign of them hiking anytime soon. Growth is good, inflation's sticky, top line growth's going to be solid off the back of that. Why wouldn't I be a buyer here?
Well, it's funny. I know when you guys had Torsten Slotkin and Tom King talks about it's a GDP-driven event.
Sure.
And he is right about that. And that is something I agree with. I think the risk here is we've had so many people chasing these rate cuts, chasing these higher valuations, that I think we're due for that correction at this point. As long as these Treasury yields continue to rise. If Treasury yields stabilize here, I'll start to reevaluate. But once that risk-free instrument starts to become more attractive, I think you're due for an equity correction.
Very close to 5% this morning on a 2-year, 498.64. Michael, enjoyed it. It's good to see you.
Thank you.
It's been too long. It's like years in person since we've done this. Michael O'Rourke there. Thank you, sir. Equity's just about positive by 0.4%. Let's get you an update on stories elsewhere. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Opening arguments in former President Donald Trump's criminal trial are set to begin today after jury selection finished on Friday. The unprecedented case centers on Mr. Trump's efforts to cover up a sex scandal involving a hush money payment to former porn star Stormy Daniels. According to the latest filings, the former president spent $4.9 million on legal fees in March and has just $6.8 million left in the accounts he's been using to fund his lawyers. Classes at Columbia University will be held virtually today after reports of anti-Semitic statements and actions on campus. Anti-Semitism at the pro-Palestinian demonstrations is drawing backlash from members of Congress and the White House. Columbia, the latest institution on the radar of Congresspeople after its treatment of anti-Semitism, after Harvard, MIT, and Penn all came under intense scrutiny last year. Columbia's president said leaders would come together today to discuss a way to end the crisis. And the ECB won't be swayed from cutting rates in June, even if there's uncertainty over oil prices. That, according to the Bank of France Governor Francois Villeroy. Earlier this morning, I spoke with Jane Foley of Rabobank, who said that despite concerns over rate differentials, if the U.S. doesn't cut or cuts later this year, Europe would welcome a weaker euro.
For Europe, it's quite possible that a weaker euro will actually be welcome, particularly if you're in a country like Germany. I would imagine that a period of a weak euro could actually be welcomed, given the hit to the manufacturing in Germany in particular, and the impact of the last few years of the energy crisis.
And you can watch Bloomberg Brief every morning at 5 a.m. John.
Danny, thank you. Great exchange there. Thank you very much. Heard that a few times about a weaker euro and Europe being welcomed. Up next on the program, Western allies reinforcing support for Ukraine.
This support will really strengthen the armed forces of Ukraine. And we will have a chance for victory if Ukraine really gets the weapons system, which we need so much.
That conversation up next on the program, live from New York City this morning. Good morning.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Live from New York City, welcome to the program. Equity futures on the S&P 500 positive by 0.4%. Moves again in the bond market, yields up 3 basis points on a 10-year, 465 on a 2-year this morning, breaching 5% a little bit earlier, 499 right now. Under surveillance this morning, Western allies reinforcing support for Ukraine.
I would like to say thanks to Speaker Johnson and President Biden. Indeed, it is so important. There is support from the United States of America. We will have a chance for victory if Ukraine really gets the weapons system, which we need so much. It's not only about the territory. It's about ourselves, our identity. So we cannot lose hope.
Here's the latest this morning. The US House approving more than $60 billion in aid to Ukraine. The Senate set to vote on the package tomorrow. Those funds coming on top of the European Investment Bank announcing it will allocate over $590 million to Ukraine this year, with the money set to fund housing, energy and infrastructure projects. European Investment Bank President Nadia Calvino is here in New York with us for more. President Calvino, good to see you.
Very good to see you.
Great to catch up once again. You're back from Washington, D.C. We are as well, so maybe we can compare notes. Oh. We've talked a long time about a lack of cooperation, maybe, worldwide, a breakdown between the United States and what the Europeans need and what Ukraine ultimately wants. Did you sense the same thing at all in Washington? Are we coming together or moving apart?
We're definitely coming together. Indeed, I think it was a very productive spring meetings week. We had many exchanges, and I really see a momentum in coming together and supporting Ukraine very strongly, but also deepening our cooperation within the multilateral development bank family to contribute to climate change financing, peaceful and a more, how would I say, sustainable world going forward.
We'll get some more details on your lending plans in just a moment. There has been a sense of fatigue in Congress around what is happening with Ukraine in its war, its fight against Russia. There are some people asking whether there is a different way, whether this should be something we continue with, stick with, continue funding what looks like maybe a never-ending war. What would your view on that argument be?
Well, absolutely. We need to support Ukraine. It is a very serious situation that we're living. It's a threat to democracy at the end of the day, and the way we see things, I think, in the US and Europe too. And so from the European point of view, there's no doubt our support to Ukraine is unwavering. I think the decision that has been taken by the US to provide support for more than $60 billion is very valuable. And this joins also the previous decision of the European institutions to provide 50 billion euros in the Ukraine facility, which we will manage at the European Investment Bank. And I think it will provide much valuable support for the reconstruction as well as the military effort, of course.
But President, did you see the vote counts on those aid bills? So when you look at something like the Indo-Pacific, it was 385 to 234 in the House. When it comes to Israel, it was 311 to 112. It barely got through when it came, to Ukraine. Right. How concerned are you about how deeply divided U.S. politicians are about aiding Ukraine over, say, other issues like Israel and Taiwan?
I really think that we should continue to support Ukraine. As President Zelensky was just saying on the screen, they have a chance if we continue to support them. From the European point of view, you know, Ukraine is our neighbor. It is a prospective member of the family, if I can say it this way. And thus, we need to ensure that we keep a secure environment in the region. The other conflicts are just as important. I mean, the Middle East situation is very worrying. It's a source of concern for all of us. And we should try to stop that war and that conflict, you know, as soon as possible. But Ukraine should not be forgotten.
But in the numbers, it shows that Ukraine was the hardest one for lawmakers to get through. What does this mean potentially if you were, say, to deal with a different administration, a Trump administration?
Well, I wouldn't like to speculate on U.S. politics, and I wouldn't dare to comment on the internal wheelings and dealings. But I think the most important news we have today is this got through. More than 60 billion dollars support, and this will provide a very valuable support to Ukraine at a crucial point in the conflict, in the war.
President Calvino, how much is this actually, the uncertainty, helping you to raise money for military efforts within Europe, to bolster military spending within the continent?
Well, it's obvious that, you know, some people woke up to the fact that we were more fragile than maybe we thought because of the war in Ukraine and the unwarranted aggression by Russia. Many member states, the frontline member states, I think, were already wide awake and very aware of the challenge of having this kind of neighbor. But, you know, it is absolutely clear we need to step up and support Europe's security and defense industry, and the European Investment Bank can play a role in that.
When you talk about financing it, how much are you on board with the idea of monetizing Russian assets that are harbored in Europe, maybe in tandem with the United States in terms of coming up with some sort of plan?
It's very important, I think, that we act united, and so the G7 discussions are extremely valuable so that we move ahead as one. Of course, the situation is not comparable between the US and Europe in terms of the volume of assets we are discussing. And on the European side, we are making progress. The European Commission has put forward a step-by-step plan, and so, you know, we're making some progress in making sure that these assets are put to good use in supporting Ukraine.
In supporting Ukraine, does it also include in investing in some of the military development in Europe?
I think this is a bit, you know, too soon to say how is the best use of these assets. Just see that we are really unwavering in our support to the country, and we're making progress in mobilizing all sources of financing to provide that important support.
When it comes to the Russian assets, particularly the ones in Europe, there's lots of different things being thrown around on how to actually monetize it. Do you expect a decision when the leaders meet in June in Puglia?
I certainly think this is going to be on the table. And it is a different issue to talk about the assets than talking about the proceeds coming from those assets. I think there is more unanimity on the second than the former. Many considerations are on the table, and we need to calibrate well our decisions so as to make sure that there are no unwarranted side effects.
I just wanted to wrap things up, President Calvino, with the changes you've proposed to the EIB, which is a plan to ultimately make it easier to fund defence projects. Could you talk to us a little bit about that? What can we expect? Are these changes going to go through?
I certainly think so, yes. For the past 8 years, we've been already financing Europe's security and defense industry. What we are doing now is adapting our lending policy whilst preserving a very strong financing capacity. I mean, the EIB has a AAA plus consideration in the market. We are a very strong player in financial markets. Only last week we had an auction. I was following your program this morning, and you know, it is impressive because last week we did a 5-year bond of 5 billion issuance, which was heavily oversubscribed, around 21 billion euros in demand, and we closed with an interest rate that was just 10 basis points over the US Treasury. So that, you know, shows the important financing capacity of the bank, and this is what allows us to be very competitive in financing our clients, public and private clients, and contributing to growth and prosperity in Europe and beyond. So we really need to calibrate our response as well. So far, the market is responding as we had anticipated, and I think we certainly will step up our support to Europe's security and defense industry.
Just a final comment, if we can. You, of course, were part of the Spanish government for a little while. I'm used to calling you minister. I want to get your thoughts on whether the defense spending will overwhelm the capital that could be used for developing the European economy more broadly. Are you concerned about that in any way, shape or form?
Well, certainly. That's why I said a moment ago we need to mobilize all our funding sources so as to make sure that funding our security and defense effort, contributing to peace at the end of the day, is not weakening our support to social infrastructures, innovation, the digitalization, and of course, climate action, which is a top priority and the key challenge of our time.
Nadia, it's good to see you. Thanks for dropping by.
Very good. Thank you very much.
Enjoy New York. Nadia Calvino there at the European Investment Bank. I think we started that promo in the right place. Lisa, talking about the sense of cooperation. It felt like there wasn't much over the last year or so. It looks like we've moved a little bit closer together, but to Anne-Marie's point, you can still see the cracks down in Washington.
Which is a reason why maybe there's renewed focus on trying to finance Europe's own effort at a time where a lot of people are saying there was so much reliance on the U.S. that you were able to unleash some of that funding for some of these other programs.
Up next on the program, we'll catch up with Laura Rame of FS Investments, looking ahead to this week's data, including the PCE deflator. That's coming on Friday. Live from New York, if you're just tuning in, equities near session highs, positive 0.4%. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Here's the state of play. Big week ahead. Equities doing okay to start this morning at least. Positive by 0.5% on the S&P 500. More than 40% of the market cap on the S&P reporting earnings this week. It kicks off in a big way with Tesla after the close tomorrow. Nasdaq futures positive by 0.5%. The Nasdaq 100 with its worst day of the year on Friday, attempting to snap back. The Russell, the small caps doing okay as well, up 0.5%. That's the equity board. Switch up the board and turn to the bond market. Bramo with plenty to say on the supply this week. Let's go through those numbers again. We're looking for a 2-year, $30 billion worth tomorrow. The day after, $70 billion of 5-year notes. The following day, $44 billion, Lisa, of 7-year notes.
How much demand is there going to be? Do we see sort of some of that trickle in? You know, Bob Michael, I keep going back to this. He is a bond bull. He sees it as the best buying environment going back to the early 2000s. And yet he's waiting, right? Or is everybody else on the sidelines waiting too when we see these auctions? And then could you see some real messiness that spurs additional kind of selling going forward?
He's looking for the washout to continue through the next couple of weeks. He used to say things like, don't get greedy. Don't get greedy and wait for the extra 20 basis points of spread widening. Buy now. That's what he would say. It's changed.
What, now he's saying get greedy? Get greedy.
Wait a few weeks into month end for a washout.
This has been part of the problem. How do you fight against momentum? And right now, it feels like everyone is saying an inflection point is here. And so we don't know which way the momentum is going to shift. And that, I think, is what has some investors a bit concerned.
That's the bond market. Let's turn to foreign exchange. More recently, higher yields biting into the FX market, eating away at G10, taking out currencies like the euro down to about 106. The dollar at the strongest levels we've seen all year through Friday, and we're seeing a little bit more dollar strength again this morning. How far can you push this? I think it's what RBC's Alcelinos was trying to say a little bit earlier, which is, okay, we've got all the information. How much more can you expect?
Especially since we've already almost wiped out all of the 7 rate cuts, barring fewer than 2, for the remainder of this year. What more can we get in terms of hawkish data, hawkish pronouncements from the Federal Reserve that could shift this relationship? Honestly, this is a good question. Do we still have dollar bears that are basically not capitulating yet, who are holding up the euro in this kind of relationship?
We've done a lot of work in the rates market over the last few months, that's for sure. Under surveillance, your top stories, TikTok's time is running out. The House passing a foreign aid package, including a provision requiring parent company ByteDance to divest the platform or face a ban. The Senate expected to vote in the coming days. President Biden, Anne-Marie, saying he will sign the legislation.
And already we're seeing reports about what TikTok's head of public policy head in the United States is saying, and to staff, they're saying the legislation is a clear violation of the First Amendment rights of TikTok's 170 million American users. We'll continue that fight, AKA, if this goes through, prepare for the legal battles that will continue to happen. But TikTok, now this is at a level where it's not thinking about banning or divesting. This potentially is going to be law, and then there's a number of different avenues that can happen.
Well, ByteDance and TikTok specifically are not entertaining one part of this story. What you'll hear them always talk about is the ban. What you hear the politicians talk about, well, hang on, it's ban or divest. You can divest this. I see no appetite so far. And clearly this is part of the argument they're trying to make to the consumer base here in the United States to try and lobby the government. Zero appetite, not entertaining it in any way, shape or form that they would divest that app.
China's flat out said they are not going to allow a sale. Dan Ives is expecting there to be a sale, but without the algorithm attached, which raises this question, what will TikTok look like? And he's suggesting Microsoft is the best position to potentially take it over. Again, though, ultimately, China wants this to look like the U.S. is anti-free speech. They want people to be angry.
What's China?
So it's China that blocks WhatsApp.
But they say
overnight.
all the time. I mean, do
blocks,
they? I'm not saying
blocks out
consistency.
television networks if they mention the Chinese Communist Party. I do think that, yes, potentially China is coming out and they're saying, we will not allow a sale. They are going to negotiate from this position of strength.
I'm sure this show just went to black in China. It'll come back up in just a moment when we start talking about other things.
We're not on it.
Mag 7 earnings set to steal the spotlight this week. Tesla reporting tomorrow. The EV maker under pressure as it cuts prices in China once again. Investors worrying about CEO Elon Musk's focus on the robo-taxi. Earnings continuing Wednesday with Meta and Thursday with Alphabet and Microsoft as well. Brahma, that's 4 of the big 7.
And really, the key question is to me, if we're at this inflection point, and yes, I'm still on that, what is this information going to give us in terms of whether this is a buy the dip moment or whether this is just the beginning of a washout that can continue? Ultimately, I do think that the idea of Alphabet and Microsoft really does loom large for me. How are you deploying artificial intelligence? If there is a sign it isn't being deployed as quickly as people thought in the hopes and dreams of ChatGPT, could that shift the narrative? Or are we just looking at, again, the thunderous 3? I mean, ultimately, I just keep going back to this. I don't see it. Well, I really do see this as a rebrand moment.
Does any of this matter until the end of May when we get NVIDIA, when Goldman Sachs says it's the most important stock on earth?
I won't try and be contrarian about this. I think, as it has been for a long, long time, Apple for me. I just want to know what Apple did next week. Big struggle in places like China. We've always been talking about the end of Apple and the dominance of the smartphone. Things are lining up in the wrong way for that company. You think of the pushback in Washington, D.C., the consumer pushback in China. They always seem to be able to pull it off. Whenever those doubts start to build, they're able to sort of blow them up and carry on, and stocks go to new highs, and they've got that massive capital return program supporting the name. I just wonder how different things will feel next week.
Especially because China's a big question mark. And what's the next big thing? Can they compete with artificial intelligence? Ultimately, every time I doubt Apple, I look at the line outside of an Apple store of people waiting for the privilege to drop thousands of dollars on little goods for them and their kids. And you think, okay, how can I be contrarian against this? But do we start to talk about a new paradigm like you're talking about with artificial intelligence? And is Samsung going to get the upper hand? I don't know.
Siri on steroids is what we're looking for later this year. Is that right?
Well, do you actually use Siri ever?
No, never have done. Never have done.
I honestly, it's not fun for me.
I use Siri only when I don't want to use Shazam. So what is the name of this song? You can just ask Siri. It's easier than downloading Shazam. I will say, though, over the weekend, Mark Gurman put out a note saying that what Apple needs is a true low-end iPhone. And that is the only way they're going to be able to revive growth.
Apple positive in the free market by 0.6%. Another read on inflation later on this week. The Fed's preferred gauge, the PCE deflator, coming on Friday. Bloomberg survey expecting core PCE to cool slightly year over year to 2.7%. The data likely to confirm that progress on inflation has stalled, supporting a shift from Fed officials that rates will stay higher for longer. Laura Rame of FS Investments joins us now for more. Laura, you've been talking about this for a while. Looks like Fed officials are coming to your side of the boat and starting to think about whether we are truly restrictive. Laura, one thing you said to us last time we spoke was the prospect of surgical cuts. They were still on the table for you later this year. Is that still the case?
It is, because I think the Fed is really determined. And that, to me, is the difference between really staying on hold or deciding that they want to take this plunge into the rate cut pool. They've been stating that they want to for a long time. And I think it would take a really big revision higher in their sort of R-star estimates to get us to a place where they really feel comfortable staying on hold. But, you know, the data could continue to surprise to the upside. I get caught in this sort of question of, do I think they should cut or will they cut? And again, it just seems like really the best argument today is that they want to. And, you know, you still hear that through the, like, maybe we have to wait rhetoric that has now bubbled up to the top.
So, Laura, I do wonder then how we've reset the bar. You said there is scope for upside surprises still. I just wonder how little or how much it would actually take to reintroduce a conversation at the Fed to cut interest rates sometime soon, perhaps as soon as July.
So, you know, what we need to see is this core, you know, sort of super core shelter, and then the other piece of the services inflation picture really reducing. Because today we're in a situation where goods prices have come down. I think we'd also need to see the wages piece. So it's not just one data point, it's really the collection. The same collection that really did behave so well in Q2 and Q3 of last year. But that's not my expectation. My expectation is that they continue to be stubborn. I think the Fed could very well see the other impetus being housing really cratering more. We've just gotten some pretty nasty housing data, and I think that could be a place too where the argument comes in that we do just need to help that market along a little bit. And I think finally the third leg of the answer there is the 10-year. I expect the 10-year to retest 10%, 5% sometime this year. But if we get there really fast and the volatility in long-term rates feels out of control, I think the Fed could come back in dovish just to try to cool down the volatility in that market.
You know, another thing that you said, Laura, that I thought was fascinating is, can markets live with higher rates? And your answer is yes, absolutely. And that's what you've seen in the market, which raises the question not about near-term communication from the Fed, but longer term, how high rates could be if they are dovish even and cut rates once, that basically we're looking even at a 5-handle Fed funds rate, if not, you know, 4.75 for the foreseeable future. Is that the reality that you're looking at?
It is, because think about a world where we avoid a recession. I very much expect that we're in that world and hope that we are. this inverted yield curve has got to renormalize. And to me, it's a combination of these surgical rate cuts and longer term rates drifting higher. And so, this is not altogether a bad thing. A normal yield curve would be welcome for our banking system. And really, I think it would show that we have sort of finally reached a normal, healthy outlook in the bond market. But long-term rates are something that higher long-term rates are something we can learn to live with. And I think companies will start to bake that in. And that is what we're seeing across the board. It's going to take time, and I think it speaks to the need to quell volatility in long-term rates, at the same time allowing them to make a controlled move higher. And I think that's what we've really seen until the last month or so. That's what has hit markets somewhat, that and uncertainty around policy.
Laura, what are you more interested in this week? The PCE data that we get on Friday in terms of also personal spending and income, or what we hear from companies, the 178 that are reporting earnings this week?
I think companies, because this is another feature of this market. If growth is strong enough and they're expecting demand to be strong enough, that can offset the problems or the funding pressures that higher interest rates can give us. So, you asked, there's been a lot of talk about AI, adopting AI throughout the earnings conversations of the Magnificent Seven. And to me, this is a really interesting place where what is good for the economy is not always good for earnings, because investment spending plans, which are going to be required, right, to implement AI, that's great for economic growth. And I think really could continue this virtuous cycle of slightly higher rates and stronger growth. That's not necessarily good for free cash flow margin, and that could impact earnings going forward. So this is, I think, something we're going to see this dynamic play out this week, and I think it'll be fascinating.
Laura, we're seeing a reprieve in the oil market, but for now is what many investors are saying. If we see closer to $100 a barrel, how much is that going to impact profitability companies are able to have?
To me, that's a huge threshold point. And one of the risks to the economy that I'm looking at is commodity prices, specifically energy prices. Oil at $100 a barrel, companies really seem to feel like their animal spirits are deeply impacted at that threshold. And $5 a gallon for the household is a really critical threshold as well. That seems to be a psychological breaking point for households and their monthly budgets.
Laura, what would you expect from the Fed next week, just in terms of the conversation, the tone of the news conference?
QT is finally, I think, going to be walked back. It's something that we're not talking about very much, but I think that is going to be the bigger policy shift. And I think they're still going to leave themselves room for flexibility when they talk about the economy and markets. So that is going to be more of a dominant feature than sort of slamming the door on rate cuts or taking a more definitive tone. I think it's going to be, not now, but probably later, and they're still going to keep that maximum flexibility language.
Laura, wonderful to get your perspective on things. Lara Raim there of FS Investments following a big repricing of the bond market. Stunning, more than 70 basis points higher at the front end of the curve. And this game that we often play. If I told you we'd be up 70 basis points at the front end, I'm not sure you'd have 4 percentage points of gains on the S&P. You'd think we'd be down 10%.
Well, let me tell you, Michael O'Rourke had a point just a couple minutes ago that I thought was fascinating about how the 10-year Treasury yield is now above and has been above the S&P 500 earnings yield for 3 straight weeks. The last time that it was above the S&P 500 earnings yield was 2002. So it raises this question, okay, well, then which is going to bite first? Is it going to be a stock sell-off that brings that more into some sort of right? Or is it going to be some sort of bond market rally akin to what Bob Michael was talking about?
The competition for capital continues. 463 on a US 10-year right now, up just about a single basis point on the session. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. UBS is cutting the big 6 tech stocks ahead of their upcoming earnings. Jonathan Golub downgraded Apple, Amazon, Meta, Alphabet, Microsoft, and NVIDIA all to neutral from previously overweight. The team wrote in a note to clients that the companies are losing earnings momentum and face tough comps. UBS says the downgrade doesn't apply to the rest of the sector. And of the big tech names, plenty of focus on NVIDIA. It suffered its biggest drop in 4 years on Friday and the highest put volume since 2017. RBC's Amy Wu Silverman told me this morning that the left tail is finally waking up.
In terms of NVIDIA, it's just about weightiness, so it's this idea of maybe positioning-wise, people have gotten long, people have dipped their toe in the water, they've jumped in the pool, so of course, there's simply more to hedge, but there's also this idea that if tech goes, the market goes.
And she spoke with me on The Brief, which you can watch every morning at 5 a.m. Eastern. Mexico's leading presidential candidate, Claudia Sheinbaum, is confident that she'll have a strong relationship with either Donald Trump or Joe Biden ahead of the elections for both countries. Both Trump and Biden have pushed for tougher restrictions on immigration at the Mexican border. Sheinbaum told Bloomberg the best path forward was to cooperate on economic development.
Yo creo que va a ser buena.
I think it will be good whether President Biden or President Trump wins. We have a very strong economic integration with the United States. We are now the principal trading partner, and that requires us to have a good relationship. Now, I think that obviously we are always going to defend Mexicans abroad. We are not in favor of any discriminatory discourse, but there is going to be a good relationship.
That's your brief, John.
Danny, thank you. I love this note from Jonathan Golub. Golub, come on a program. Need to talk about this. Downgrading the big six, maintaining the overweight to the rest of tech. What's left of it? After you've downgraded Apple, Amazon, Google, Meta, Microsoft, and NVIDIA, what's left of it?
A lot of smaller companies that nobody has heard of and that maybe they can catch a bid after not rallying this to the same degree.
That UBS note catching a lot of eyes this morning. Up next on the program, it's Tesla's tipping point.
There's a lot to look forward to in 2024. Tesla is currently between two major growth waves. We're focused on making sure that our next growth wave, driven by next-gen vehicle, energy storage, full self-driving, and other projects, is executed as well as possible.
That conversation up next, live from New York. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Phil, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great.
Minutes away from the opening bell. Equities positive by 0.6% on the S&P. Yields higher by 2 basis points, 463.94. Other Savannahs this morning, it's Tesla's tipping point. Here's the latest. Tesla shares sliding nearly 41% this year due to slumping sales, price cuts, and increased competition in China. The CEO, Elon Musk, also seeming to change course. Sources telling Bloomberg that Musk is staking the future of his company on a robotaxi, a project that Tesla does not have the infrastructure for. Bloomberg's Ed Ludlow joins us now for more. Ed, you've covered this story so well over the last few years. What's the big one you're looking for tomorrow afternoon?
Well, it's good timing. You know, we write in the big take that a company that's accustomed to chaos has kind of reached a threshold of chaos to which they're unaccustomed, and so the earnings call is everything. I think it's just clarity. You know, what we're reporting is that, yes, a robo-taxi is the priority, but where is it at? You know, it's one thing to set a date for August 8th, the assumption being they'll unveil a prototype, but what is the plan for that? And then I think we did give some clarity in that big take around the idea of a $25,000 EV. I think the world was kind of expecting Tesla to come with the kind of Honda Civic of the EV world. And my understanding is that that's just not the case. They did a lot of work at the component level with technology and the production level to work out how they could wring out cost. Classic Elon Musk. And my understanding is that that project was successful. It continues. And actually what they will do long term is apply that work to cost savings on their existing cars, offer them more cheaply. I guess we will see whether we're right on Tuesday when he takes that call.
It takes us to margins. Let's talk about margins. The stock is down by close to 5% in the pre-market this morning. I think a lot of us were willing to give the company the benefit of doubt. When the price cuts first started, they've got the margins. They can squeeze the competition, prevent them from taking market share, just as they go through a very expensive ramp-up in production at legacy automakers. I think we all understood that argument. Where's that argument now, Ed?
Yeah, the margin debate puts your eye very closely on China. You know, the price cuts there are interesting because the reaction from the sell side, at least, is to start to worry that some of the most profitable cars that Tesla makes in China will not be even break even, let alone have positive EBIT. And it's really interesting economics, right? Model Y is basically the world's best-selling car or SUV. And what I learned in the last 7 days is that in China, 2/3 of what they sell is the lowest spec rear-wheel drive Model Y. So its margin profile is less, but because China's supply chain and cost of production is so much lower, the bill of materials are lower, it's a much more profitable thing. That's changing, so we're a little bit worried about that. Zach Kirkhorn, who you remember left as CFO in August, he was the bottom line magician. You know, that was his focus. And my understanding is that actually all of these cuts we're going through, the layoffs, all the stuff that's happening, Musk's motivation is actually not the bottom line or cost at all. It's simply psychological, which we can get into. But I think that's the point, that the investors looking at this going, what are you focused on here? Why are you letting the bottom line unravel? You know, price cuts have been a useful lever, but they continue without an end at the moment.
What's demon mode, Ed?
Yeah, demon mode or wartime CEO mode. And this is what I'm hearing. So let's take the layoffs as an example. I'm told that Musk looked at the 1Q delivery performance, where deliveries fell 20% sequentially, and completely outside of financial consideration, he basically said, okay, if deliveries drop 20%, we should cut headcount by 20%, just to keep everybody on their toes, just to keep everyone in a state of paranoia, where they know that if we're too big, that would be bad. And this is classic Elon right now. I also get the sense that he's been a bit busy recently with some other companies, and I think he's kind of come back to Tesla quite recently and looked at what's going on and doesn't like it. And so he's getting more hands-on now, focused on robotaxi, and just to kind of plug the reporting one final time, I think they're making a lot of progress on the software side with robotaxi, but now he's like, this is my vision, and if you don't like it, you're out.
Okay, but Ed, when I think of the robo-taxi, I think of Uber's self-driving cars. Arizona's former governor wanted them all to come in, and then there was a tragic death, and then Uber had to sell this off. How risky is betting the entire farm on robo-taxis?
It's risky, but all you can do is bring the horse to water, right? You know, Elon Musk is going to make a robo-taxi. Elon Musk is often late against his own timelines, but pretty much always delivers on the thing that he says he's going to do. One interesting departure of the last 7 days was Tesla's public policy chief, Rohan Patel. He would have been the person that would have to go to the regulators and say, well, we have a robo-taxi. Are you going to let us use it in the real world? And my sense is that he thought, my goodness, it's not worth it for me. I don't think that that's a straightforward battle to have. So you're completely right. Tesla will operationally do what it can to make a prototype of a standalone robotaxi, develop the software, and I believe they're making progress in the domain of specific software for a robotaxi. But the rest of it is out of their hands from the regulator's point of view. And as we've learned through Cruise and Waymo, even the most prudent and safe approaches are still fraught with risk because the regulators have a low threshold for pain or problems along the way.
Just a final one. Do you think this is a Tesla problem or a sector problem?
From an EV standpoint, in terms of demand, I think it's pretty much both. You know, Tesla, whether people like it or not, has the specific problem of reputational risk and Elon Musk's behavior at the moment. That is tangibly having an impact on consumer demand. But again, why are they sort of focusing on a robotaxi? Because right now the market for EVs, early adopters, it's been and gone. You know, what I'm hearing overnight, for example, is that they've kind of already given up on this nascent marketing effort to do traditional marketing and advertising.
Yeah.
And investors have pushed for that because they wanted people who don't know anything about Tesla to know about it.
This was great. We'll catch up again tomorrow. Looking forward to the program a little bit later. Bloomberg Technology, 11 Eastern Time. Caroline Hyde and Ed Ludlow. Coming up tomorrow, we'll catch up with the SAP CFO. We'll speak to Citi's Andrew Hollenhorst. He says wait and PCE.
Yeah.
You like that?
Yeah,
You
I think
love
it's
that,
awesome.
don't you? I know.
I do. I'm going to say that.
JP Morgan's Priya Misra is going to be joining us together with Morgan Stanley's Mike Wilson. A lot to talk about. 34 minutes away from the opening bell. Equity futures positive by 0.6%. This was Bloomberg Surveillance.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From New York City, for our viewers worldwide, I'm Manus Granny in for Jonathan Ferro. A spirited attempt by equities to bounce back after 6 days of losses. Tesla is consumed by chaos. We'll dig into that as we count you down to the open.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Coming up at the show, futures tick higher after 6 straight days of losses. Earnings season kicks in with the busiest week arriving on Wall Street. And as I said, Tesla announces another round of price cuts. We begin with a big issue. It is crunch time for big tech.
For as long as I can remember this year, it's been all about the right tail, about that FOMO and MOMO. And I really think the biggest inflection point difference is that left tail is waking up. And, you know, I just want to say one thing. Look, it's not that NVIDIA hasn't sold off before. We've seen that happen. It's the first time, though, in options where that left tail has picked up because of it.
It is all about the left tail risk. Morgan Stanley's Brian Weinstein and Bank of America's Matt Dizok join me now. Gentlemen, good to see you this morning. Left tail risk rises in equity markets. It's up by 45 basis points of a jolt higher in yields. Brian, is the left tail risk priced in bonds but not equities?
No, I don't think that's right. I mean, I think the equity market gets that bond yields here are a risk, and they've sold off accordingly. There's some challengers out there now for equities if you want to own some income. So I think the market has done an appropriate job of starting to adjust for the fact that it's not all right tail risk. Things do go down. Things can correct. Throw in some geopolitical and some political and, you know, some debt issues. And I think we've adjusted fairly accurately.
I'm being disingenuous then to the equity market. Good morning to you, Matt. How are you doing? Left tail risks, how do you assess them? And how do you feel in terms of the mechanics of pricing into the bond market relative to the equity market, given that you're slightly more fixed income?
Yeah, listen, we feel good about the repricing in bond markets. We think it's appropriate. We think clearly the bond market got ahead of itself in January when it was expecting 7 Fed cuts. So from a big picture perspective, nothing's really changed here. The Fed spent a lot of time last year talking about higher for longer. They'd gotten the 10-year up to that 5% level, which was the right place to be, and try and slow the economy, bring inflation down. But then they got talking too dovish. The market got ahead of themselves. But the main drivers we're seeing, deficits still too high, about 6% of GDP. Liquidity is still too much. The Fed actually didn't drain reserves of the last year. The Fed increased reserves unintentionally from 2.8 to 3.6 trillion. So too much liquidity, too much spending. They need to keep rates higher for longer to get the economy down. And rates rising now is a good, provides a good ability for clients to extend duration, take advantage of higher nominal, but more importantly, higher real rates in this environment. That's a good opportunity for folks in fixed income markets.
Okay, you and the real money should, in theory, arrive. That's, of course, in case the Fed doesn't raise rates. Let's talk about the traders, what they're bracing for this week. It's going to be a busy week on the economics data front. We've got Bloomberg's Mike McKee in the studio to set the agenda. I don't know whether I've got 4 days of volatility in me until the PCE on Friday. Mike, good morning.
Well, we are going to have a little bit of a wait, Manus, to get the numbers that are really going to matter and could affect interest rates for those who are worried about them in the equity markets. We're backloaded Thursday. GDP, the fourth quarter was very strong. The first quarter consensus is 2.5%, but the Atlanta Fed says it could be 2.9, so upside risk there. And then PCE headline and core both expected to come in on a month-over-month basis about the same way, but as with CPI, the headline goes up on a year-over-year basis, the core goes down. We'll see how the markets react to that. Also Friday, personal income and personal spending expected to be strong. People will still have money to spend, and they're probably still spending it. Now, the question is, how does the Fed react to all this? Well, guess what? We're not going to know. Here's the calendar for Fed speak this week. Yeah, we're in the blackout period, so there is no Fed speak this week, so you just got to wait until the 1st of May for them to react with their decision. We will get a view, though, on rate cuts from the markets right now. Here's where we are. November is seen barely as the first time we get a 1 rate cut, and then we get 1.5 by December. So somewhere in that time period is what the market is thinking. But if we can get a drop in inflation or a rise in inflation on Friday, those will probably move around quite a bit.
Well, let's see. As you say, that's fairly anemic. 1 in November, 1.5 by December. Mike, thank you very much. My guests this morning are Brian Weinstein and Matt Dizok. Gentlemen, when I look at the PCE, we've had the PPI, we've had the CPI, we've had the jolts, we've had a bit of a jolt in that. How do you perceive the train of disinflation? Because I'm looking at what Apollo are writing. They're saying you're going to need a print. You're going to need a print of 0.1% on the PC all the way through to December to hit the target of 2%. Brian, do you think that we are on that kind of a trajectory for disinflation? I don't think so.
No, I don't think so. I also don't think the Fed needs that to ease, right? I mean, remember, 5.5% where we are now was a reaction to inflation going up to 8 and 9%. So inflation doesn't have to go 0.1 forever to get
that is to hit target. I should, you know, I qualify. That is to,
yeah,
that is
right.
to hit target.
Yeah. And we can debate the target, right? I mean, I think we're inching up in break-evens. I think the market gets that we're not going right back to 2. But that doesn't mean the Fed can't ease 2 or 3 times this year in order to ensure the soft landing that they want. So I still think, listen, 7 was too many. We were on that. I think at 1.5, you get paid to make the bet. Maybe not today, but over the next couple of months, that we will have some prints that point back towards that 2 to 3% range, and the Fed can normalize rates a little bit. By the way, it may cause 10-year notes to go higher, so it's not a free lunch easing a little bit. It might cause the market to overreact and fear more about future inflation, but I do think the Fed will ease 2 or 3 times later on this year.
And maybe that is what takes us to 5%. Matt, in terms of the road to disinflation, as Brian just said, we can debate where the higher natural rate is or the normal rate. We can debate when the Fed can begin to cut. But the risk of disinflation is challenged by oil. It is challenged by a whole host of other quasi-inflationary issues, not least geopolitics. The road to disinflation, how bumpy will it be? Continued disinflation.
It should be a little bit bumpy from here. Again, we don't want to worry too much about one report, January, February, or March. You've got to realize we're dealing with 2 important lags here. First of all, inflation itself is a lagging indicator. It doesn't tell us what's happening or what's going to happen. It tells us what happened. So that's one lag we have to worry about. So even if as long as the disinflation is on the right trend, the Fed can start to cut. But it's sort of plateaued here. And you're hearing talk of the consumer being interest rate insensitive or rate hikes not working. Way too early to be saying that. We hear this sort of every time. The news cycle, that lag is a lot shorter than the monetary policy lag. The monetary policy lag is 12 to 24 months. And we just got the 10-year to peak in October, November of last year. The Fed funds rate just hit 5 3/8 in July of last year. So we're not even into that 1-year period. So don't say rate hikes aren't working. Come back to us in 2025 and tell us if rate hikes haven't worked. And from a lot of the anecdotal data I'm seeing, traveling and seeing clients, the slowdown is starting to bite, and give it another 12, 18 months. The Fed will probably get what it wants, which is disinflation to continue, but as you know, on a bumpier path.
Just briefly, Matt, when you're on the road talking to clients, 12 to 18 months out, the trajectory forward, is there some kind of material break, or is it just a slow, quiet, silent, assassin-like slowdown?
Well, it doesn't say there's going to be a huge break, and we certainly hope there's not a huge break, and the Fed is attuned to stop a huge break. But if you talk to commercial real estate developers in the Southwest and the West, they're starting to feel the pain of higher rates. You talk to an owner of an auto dealership, sales are way down. A lot of folks are taking their leases and buying those car backs instead of buying new cars or being able to lease at a higher price. You talk to restaurant owners. Saturdays, Sundays are still pretty good. Wednesdays, Thursdays, not as good. So again, you're seeing what you usually see. You're seeing rate hikes. You're seeing the economy slow. It's not even. There has been an influx of labor that's balancing the supply and demand picture on the labor front, which is keeping wages in check. But again, the big jump in prices is still biting people's pocketbooks. We do think rate hikes are working. We do think 5 3/8 should be the high for the cycle. And if they're wrong, they just need to keep rates at that level. Again, maybe one cut this year, but likely hikes are out of the picture. And if that's the case, then real rates at that low 2% level, 2 to 2.5% across the curve, that will look quite attractive in a couple of years' time.
Yeah, I mean, the reason why probably they're not busy on a Wednesday or Thursday night is because we're actually back at the office and the work from home. The ability to stay up a little bit late on a Wednesday night has dissipated. Brian, when you look at the IMF meetings last week, it was very interesting. A couple of big themes, really, really prevalent. The beration of the United States policy on strong dollar, but also the growth differential for the United States. The IMF upgrades growth to 2.7% from 2.1%. You get a flash reading this week. But this underpins, in part, your thesis on credit.
Yeah, listen, the U.S. government keeps spending and growth keeps going up. Or stays high, so I don't think it's that surprising. The outlook on credit, I think, is good. In fact, I think with all this noise about what a bad borrower the U.S. government is acting like, I think credit looks even better. So I think you're going to see continued tights in credit spreads. I'm not sure it's logical, but I do think people are avoiding the government because the headlines are bad. Take your extra spread. Earnings are good. Earnings estimates keep going up. The Fed could ease a little bit to help, and so I think credit continues to be on a really good trajectory, and you can earn income while waiting. So I like credit, even though it seems rich here. I think it's a good environment for credit.
What about a bit of credit for you, Matt, on the other side? I mean, did you just say the bad actor, which is the government, or was that the phrase? The bad actor was the government, so stay away from sovereigns and eat a bit of credit. How does credit look for you, Matt?
We don't disagree with a lot of what Brian is saying, and we agree. The conditions look good for credit. We're not concerned about the trends in credit. We do think it's actually rational. At the end of the day, a diversified investment-grade bond portfolio does not deliver you a lot of credit losses. Even though it's a credit product, 95% plus of the spread you get is really for liquidity, for mark-to-market risk, for spread risk. And so in an environment where the Fed is attuned to put the fires on any liquidity risks, premiums should be tighter. But from our perspective, right now, investment-grade credit, municipals, high yield are all pricing in a donut, not a zip, zilch, zero chance of a recession. That's a little bit too much for us. So we're slightly underweight credit risk here and actually slightly overweight rate risk. A preference for treasuries, a preference for agency mortgage-backed securities. They've already extended. People are not going to prepay their 2% mortgages. So we do like taking additional risk on the rate risk side. But again, it's a slight modest tilt to rate risk, again, conditioned on these higher real rates, which we find on a 20-year time frame to be quite attractive.
I just let you both in on a secret. I've still got a base plus an eighth mortgage. There you go. Never in the history of money will anybody ever price a mortgage again at base plus, it was called LIBOR. It was called LIBOR plus an eighth, but it's base plus an eighth of 1%. That's the Brits for you. Now, the one big issue as well is get ready for an oil shock. And the fixed income market, to a certain extent, has grappled with $90 in Brent. It's unsure that you're going to get an oil shock. To what extent, Brian, do you worry about an oil shock? And does the fixed income market, has it even computed that as a left tail risk?
Yeah, listen, you worry about it a little bit, certainly on days when the drones are in the air, and it does come up. Listen, I don't think the market doesn't price geopolitical risk that well. It tends to overreact during the event and over the weekends where things may happen. So no, listen, if oil goes into the 90s, into the hundreds, I think you have to reevaluate, right? It hurts the consumer. It's inflationary, but it also slows growth. There are certain companies and industries that it really, really goes after. Listen, I think we're on a trajectory for energy prices to grind higher over the coming years as we just use more of it and haven't produced enough or don't have enough refineries and things of the like. But no, I don't think the market is priced for an oil spike, and I don't think the market is efficient enough to know if that's coming or not and to play it correctly.
Matt, in 30 seconds, fill or kill on oil as a material risk, or are you okay so long as it stays sub $100?
Not a material risk. Difference between inflationary pressures and actual inflation. Oil price goes up does not mean people are going to spend more on cars and still spend everything else. Oil prices go up, they're going to spend less. Oil price hike might actually work like a rate hike, help slow the economy. Again, differentiate between inflationary pressures and actual inflation. We think the consumer is going to feel the pinch a little bit, spend less elsewhere, and we're not worried about higher oil prices transferring to higher inflation economy-wide.
Okay, nice and succinct. Gentlemen, thank you so much for being with me. That's Matt Dizok and Brian Weinstein on the bond markets this morning. Join me now. Let's go under the hood. 16 minutes to go until the opening bell rings. Abigail Doolittle has the detail. Abby.
Well, we're looking at the possibility of something that we've not seen over the last 6 trading sessions, Manus, and that, of course, is an up day. Helping out right now in the pre-market, Verizon shares are higher, up more than 2%. They beat adjusted earnings by nearly 3%. There was a small revenue miss, but investors and analysts really like the fact that they affirmed the outlook for the year, plus saying that the wireless business trends, some analysts are saying, are solid. Now, Salesforce.com adding to previous gains, up 4.1%. The early news was that the deal talk between this company and Informatica had broken down. Well, we just have breaking news now. Informatica not engaged in acquisition talks to be acquired. They've also pre-announced for their first quarter saying revenue subscription should be in the upper half of the range. So trying to assure investors, as we now have the news, that Informatica and Salesforce will not be merging together. And then Tesla down 4.25%. The latest price cuts in China are weighing on EBIT and could, in fact, weigh on profits in that area. Tesla now, Manus, is down a stunning more than 40% this year alone.
Yeah, I mean, the headline is chaos at Tesla. They spent the weekend cutting prices. We'll dig into that shortly. Abby, thank you very much. And as I just said, there are no shortage of problems at Tesla.
They're going to make autonomy, robo-taxis 5-6 years from now. We're talking right now, you're at the edge of a cliff. It's for Musk to bring it back, fork in the road, navigate through this Category 5 storm.
Well, Tesla faces the 7th consecutive day of declines, announcing another major round of price cuts ahead of Tuesday's earnings. The conversation and context on Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe 1 stage or 2 stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. what are things that you need to have 12 months from now, 24 months from now that you currently don't have, then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do three things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
We reported as part of the big take that Musk was targeting not more than 10%, as he said in his internal memo and regulatory filing, but it will probably be nearer to 20%. Around 20,000 staff or more will be gone. And so I think investors just look at it and say, just give us a sign or a signal what the big picture is here. Well, the market hasn't taken the sign of a 10% headcount cut as being something constructive. And if we're hanging our hats on robo-taxis, is that a pipe dream relative to what it actually is? Robo-taxis are not going to turn the entire narrative of Tesla around, or correct me, feel free.
No, it's a really good question. Historically in the technology industry, you know, job cuts signal prudence. Investors cheer that because they think, lower costs protect the bottom line. What I reported over the weekend is that the headcount reduction had nothing to do with targeting cost savings, really. My understanding is that Musk was pretty angry at the first quarter deliveries. He said if deliveries were down 20% sequentially, we should cut headcount by 20%. Why keep everyone on their toes? Classic Elon Musk psychology, paranoia that they've got too big. And it doesn't relate to robotaxi either. I think that Musk has been away from Tesla.
But respectfully, Ed, there's nothing particularly genius-like about that. That is GE reincarnated. That was the GE philosophy 30 years ago when I worked for them. There's nothing genius about keeping the bottom quartile discombobulated.
So this is my point, and this is my understanding, from dozens of phone calls in the last 7 days. I think Elon Musk has been away doing other things, and he's come back to Tesla and looked at everything that's happened and said, right, I'm actually going to get back and hands-on now. And the thing is that all of these things are happening in parallel. The layoffs, the pivot to robotaxi, the rethink on a $25,000 EV. And that's why this earnings call in 24 hours' time is so important. We're on track for the first year-on-year drop in revenue since the second quarter of 2020, a 40% drop in operating income. And I think investors in the short, medium, and long term are just a bit confused about what the plan is here because of lots of contradictory reports from the media and statements from Elon Musk on social media. They just want to know what's the plan and how we're going to get out of this trough.
What do you think changes the narrative tomorrow?
I think it's the idea that $25,000 EV, I think, was highly misunderstood. Investors, particularly those most bullish on Tesla on the street, the institutionals, thought that basically the Honda Civic of the EV world was crucial to the bull thesis long term. I don't think Tesla really ever was singularly focused on this really cheap individual product. I think they did a lot of work to wring out cost on the component side, on the production side. And if Elon Musk goes on the call and just explains, we did a lot of work to bring costs down. So in the future, we can offer a much cheaper EV in multiple variants. The street will go, okay, we understand now. That's muddied by the robotaxi. And even though we have a date, August 8th, for reveal of a robotaxi, I don't think anyone really understands what it is that's being revealed. Is it a prototype? Does it have a steering wheel? Does it not? Quite straightforward questions. And I think that there is a chance those questions will be asked by the sell side. Whether he answers them or not remains to be seen.
Okay, let's see what tomorrow brings. Thank you so much. Great context. We look forward to seeing you and Caroline a little bit later on, digging deeper into the Tesla story. Coming up, your morning calls. And it's busiest week for earnings season. We'll set the stage with Sanctuary Wealth's Mary Ann Bartal. She joins me for that conversation around the opening bell on Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
So it's a spirited attempt by equities, but some green on the screen. You're going to have a monster week in terms of reporting. $18 trillion worth of market cap reports. UBS goes to neutral from overweight on big tech. Mag 6 leaves the rest. There's not much left to play with. That's steady play on the equities on the way up. Your morning calls look a little bit like this. The scribes of Wall Street have penned. Morgan Stanley upgrades Alcoa to equal weight, pointing to recent cost control measures and improving valuation. JP Morgan resumes its coverage of Cisco with a neutral rating, seeing limited upside given the company's muted outlook. And finally, Stifel upgrades Papa John's to a hold, highlighting reasonable expectations and weakening competition. Papa John's Pizza. There you go. Marianne Bartels joins me shortly to talk you through your risk on markets on Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
90% of the S&P 500 will deliver their verdict on the first quarter. What will big tech deliver? That is the question. You're going to hear from Tesla. You're going to hear from the Mag 4 this week. NASDAQ up 0.6%. Some of these stocks are trying to do a spirited attempt at a turnaround. NVIDIA down 10% on Friday, over $200 billion lost in value. It's a small bounce back there this morning. The Russell up 0.5% on the broader market. We're kind of down to the PCE this week. You're looking at the dollar up, the euro down again. The momentum in this rates market is a trajectory higher and a stronger dollar. You're looking at 10-year yields ticking up by 2 basis points. How much of the $183 billion of paper, 2s, 5s, and 7s and auctions this week can be absorbed easily with no indigestion? Oil is down by 1.25% as we see new sanctions on Iran's oil sector. We see an uneasy calm in the Middle East. And indeed, what you're seeing here is a reversion as geopolitics reduces ever so slightly. So the market returns to perhaps some of the supply and demand, the basics of this market. Right now, the market tipping to the downside this morning. One stock to watch is Tesla. You can't talk enough about this stock at the moment. The EV maker cutting its model prices over the weekend. China and Europe is where they took out most of the price cuts. And this is on the driver assistance software in the US. Driver assistance software, you were telling me that this is something you had to do before you got to buy your Tesla. I mean, again, it's the bank of hope, isn't it, in terms of the story of Tesla?
Yeah, so FSD was cut from $12,000 to $8,000 if you pay up front. Musk had already moved to make it a much cheaper subscription at $99 a month from $199 a month. Down 4.6% at the open, bouncing around, but Tesla is on track for its 7th straight day of declines, something that hasn't happened since December of 2022. From a market cap perspective, we're now below $450 billion of market cap, and as you've been talking about, the decline now well beyond 40% year to date. The price cuts particularly concerning in China to the sell side. There is a note out from Evercore, for example, saying that, well, actually, if you look at how deeply they've cut prices in China, the mix of China versus US-built products, traditionally China has been supportive of the bottom line because of its margin profile. There's a concern from that name that we might not even have break-even EBIT on those China-built models and possibly negative EBIT. That's a concern. So take it holistically. We have earnings in 24 hours' time where consensus is for revenue to drop for the first time year on year since the second quarter of 2020, and operating incomes dropped 40%. And in the backdrop, you have all of these layoffs. Musk had said it would be more than 10%. My understanding is that it will be well beyond 10%, nearer to 20%. And the directive that Musk gave, according to my sources, is that when 1Q deliveries were down 20% sequentially, he turned around to the business leaders and said, if we're down 20% on deliveries, we need to cut headcount 20% to stay kind of psychologically fresh. So there's lots of questions going into this call. Read the big take that we wrote. I feel we gave some clarity on where we stand, robo-taxi versus a $25,000 EV. But at the end of the day, it's for Musk to come onto the call with other executives and explain to investors what's happening. The stock now down more than 5% in Monday's session. Manus.
Yep, well, certainly Wedbush Securities were with us last week, and they said Model 2 is the holy grail within this pipeline of cash generation, and that's where we really want clarity. Thank you so much. More reporting through the day. Bloomberg Tech will be on in just a couple of hours. Let's turn our attention to software, because Salesforce and their takeover talks with Informatica have cooled as both parties struggle to agree terms, according to a person familiar with the matter. It looks as if it's dead in the water. Abigail.
Indeed, because the talks have not only cooled, but just recently Informatica coming out and saying that they are not being acquired. So the point of contention, because of course this story emerged just a week ago with the idea that Salesforce would acquire Informatica, the service software company, for more than $10 billion. It would have been one of their largest acquisitions, despite the fact that CEO Mark Benioff last year said that they were cooling off on the M&A. So a lot of people disappointed, but what Informatica Informatica investors would have been disappointed by was that that offer, the projected offer, was less than where the shares had traded prior to that announcement. And before Informatica saying the deal is off this morning, just moments ago, the sticking point, the cooling point was price. So at this point, we do have Salesforce.com up 3.2%. Its best day since February. On the other hand, Informatica, Manus, it is over since April 15th, about a week ago when this possibility was first announced, it is down more than 15%. So those investors really disappointed by the idea that it will not be acquired, the company won't be acquired. Informatica trying to assuage investors to some extent, saying, reiterating the full year guidance and also saying that the current quarter, well, it's at the high end of the range.
Abby, thank you very much. Let's turn to China. Tencent publishing the popular game Dungeon and Fighter Mobile in China on May the 21st. After 7 years of development, is it worth the wait? Katie Greifeld will weigh in with marks out of 10.
Well, this is big news in the gaming world. Like you said, just to reiterate, Tencent, it will publish Nexon's Dungeon and Fighter Mobile in China. That's its China debut on May 21st. And that spurred a rally in shares of both companies as that date is earlier than expected. Now, Citigroup out with a note saying that the market is, quote, likely to see this as a positive development for Tencent's second quarter and second half of this year game revenues. And that is a much needed boost. If you think back to Tencent's last reported earnings, remember that its core gaming business, it showed further signs of weakness. Its segment, it missed estimates for a third consecutive quarter with weaker monetization of two of its key games. So we'll see how Dungeon and Fighter is actually received, of course, in May, but there's plenty of optimism in the ADRs today. You can see Tencent currently up by more than 4%.
Okay, Katie, thank you very much. And we are going to have a big week of earnings. Let's kick it off with Verizon. They beat on the profit estimates while boosting the wireless service revenue, even as it lost retail phone customers, balancing the books. Simone has the detail.
Yeah, Manus, it lost 158,000 consumer wireless customers, but said that's actually the best quarter on a performance basis for best first quarter since 2018. So those loss of customers was less than expected, and that was therefore good news. The company also said that more people chose premium plans, and in price increases, that helped boost profits. It saw earnings per share come in at $1.15 versus an estimated $1.12. Slight miss in consumer and business revenue, but also reiterated its outlook for wireless service revenue growth, 2 to 3.5% this year. On the positive end, its internet business boomed. It added a net 437,000 broadband customers. That's the largest increase in more than a decade for a quarter. Citi said these results are a solid start for the year, but they did warn that broadband market may be slowing. However, we are on track for the biggest gain in these shares, now since March. It had been since January, as shares rally up well over 1.5%, Manus.
Simone, thank you very much. Stock is bid this morning. Our next guest writes this. Equity markets are showing signs of fatigue. The recent rise in interest rates due to stronger economic data and firm Fed speak shook the markets. Is the worst past? Sanctuary Wealth, Mary Ann Bartels with me. 4.5% down in 6 sessions. Is that a light nap or the beginning of something more brutal and more tiring?
Well, we came into the year expecting both the equity market and the bond market to be bucking. We called it, the bucking bull. Bonds have certainly, in the whole fixed income spectrum, have bucked a lot more this year. This is the real first bucking we're getting from the equity markets. But we have to put this into perspective. The markets have been in an upward trajectory since the lows of October, and the S&P at its high was up 30%. We're in a natural correction. You can correct up to 1/3 to 1/2 of any move. So we're down to around the 100-day moving average for the S&P. NASDAQ's already through that. So the risk is that we're still going to have a little bit more bucking. We could have a little bit of a rally because markets are oversold. But the risk is that we test the 200-day moving average where we get a full 10 to 11% correction, but we're buyers of the market.
So we're running into some pretty big, important announcements in Mag 4 this week from Tesla, chaos or genius. We will make up our mind tomorrow. NVIDIA will come a little bit further down in May. As you look at the event risk this week, what is it that could upset the equity market the most? Is it big notes like UBS who've downgraded to neutral on Mag 6. They say investors attribute the run in the mega cap stocks to animal spirits and the impact of AI. However, our work indicates that surging earnings momentum fueled this update. Unfortunately, that momentum is collapsing. Are you that doubtful on the earnings within the Mag, well, you can call it Mag 6 or Mag 7, whatever you want. Are you doubtful on the momentum of the earnings? Earnings were supposed to fill the gap here.
Well, if you look at street analysts and what they're estimating for Mag 7, it's the strongest pocket of earnings, and it has been, and it's expected to continue. But where I think you can get the market moving as these companies report, you know, the earnings are looking backwards. Analysts want to see where numbers are going forwards. So what companies are saying about their business and where they see their business going, I think is going to be a lot more important to the behavior of the market. And then on Friday, we get core PCE, and that could be another market mover. Now, data has been market movers since 2023. I mean, data moves markets. The question is, can earnings sustain their momentum? And when we look at the economy, at least the Atlanta GDP Now model is estimating that the economy is growing almost at 3%.
Yeah.
And companies have been able to maintain their margins, and we think margins have troughed and have bottomed and can actually grow. So we think the outlook for earnings overall remains very robust, which is one of the reasons why we want to buy this pullback.
Okay, and that adds up. You warn very clearly, though, that oil prices are a malevolent risk to the narrative. We just had two guests there now that said sort of maybe higher oil prices might be something the Fed would welcome because it's not necessarily inflationary, but it cools down the growth in the market. You warn about the folly of higher oil prices. You're okay with it sub $100 is my general read. And you still believe that it is a sector. The S&P Energy Index is at a 15-year breakout. Does that endure at around this $90 level?
So when I look at the energy complex, what we had warned clients, especially as the tensions started to build in the Middle East, is what would derail a rally in the market would be crude oil going above 100 and staying above 100. Because that would be negative for corporates, it would be negative for the consumer, and it would eventually slow down the economy, and we think would have a negative impact on earnings. And that has not materialized. Crude oil has really been able to hover in this 85, or let's say 80 to 90 range, which we think is sustainable for a growing economy. But when we look at the energy stocks, they're the cheapest assets within the market. They've delevered their balance sheet. Many of the large companies pay really nice dividends. So we think you can own energy, but we don't think they're leaders in the market. They fall into the value camp, and we still think that growth is going to be the main driver. But if you're looking to add income and growing income in your portfolio, we would own some energy stocks here.
And I love what you say. You want to rent the small caps and own the big caps. How much renting of small caps do you want to do?
So when we have secular trends in the market, they can last 15 to 20 years. And right now, we're in a large cap secular bull market. In fact, I'd argue right now it's a mega cap cycle. So although the small caps have a lot of attractive companies and attractive valuations, we don't think they get traction until the market moves away from growth to value. What would do that? An abundance of earnings. Fund managers become very selective in their valuation when we have an abundance of earnings for the S&P companies, and we're not there yet. The earnings are still very concentrated in tech, so we think the market will stay growth for now.
Okay, Marianne, thank you so much. Marianne Bartels with her warnings on growth and value. Coming up, the clock is ticking on TikTok.
The idea that we would give the Communist Party this much of a propaganda tool, as well as the ability to scrape 170 million Americans' personal data, it is a national security risk.
The House passing TikTok legislation and sending it to the Senate. That conversation next with Anne-Marie Hordern.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The idea that we would give the Communist Party this much of a propaganda tool, as well as the ability to scrape 170 million Americans' personal data, it is a national security risk. The timeline of giving this can be a complicated transaction. To give it up to a full year, I think just from a business standpoint, makes sense.
TikTok back in the spotlight on Capitol Hill over the weekend. The House fast-tracking legislation forcing the company's Chinese parent ByteDance to divest its ownership stake by tying it, I should say, to an aid package for Ukraine and Israel. TikTok pushing back, writing a memo to the staff, quote, "At the stage that the bill is signed, we will move to the courts for a legal challenge." Will that be worth having at that juncture? Amory Hordern is with me now. Let's flick it on its head. I mean, TikTok potentially being divested from ByteDance. They will challenge it. Lay out the rationale, just once again, on why the government here want TikTok, as it were, to be moved away from ByteDance. What is the simple rationale?
The simple rationale and the concern that you hear a lot in Washington is the national security concerns around TikTok, the algorithm, and the concern that they have is that this data, American data, can be accessed by China, by the Chinese Communist Party, which is why TikTok has gone to great lengths to try to keep some of that data in the United States. They've done this thing called Project Texas, but it doesn't seem like any of this has had the ability to assuage concerns of these officials. So we've been talking about for years now whether or not TikTok, potentially there could be a ban in the United States or divestment.
But what's the value in the divested version of TikTok? ByteDance divests itself of TikTok. That vehicle needs to have the algo technology that allows it to be special, the special sauce in the algos. My question is, if ByteDance sells off or hives off TikTok in the United States of America, what's the value? Because we know Steve Mnuchin and a few other people want to bid for it, potentially.
Right, there could be potentially a consortium of investors who want to get action on this, or a massive Big Ten company that maybe would want to buy it, but then potentially that would be regulatory issues. Dan Ives this morning put out a note following all this news of the House over the weekend and the fact that the Senate is set to vote tomorrow on these bills, that the House voted on 4 bills, the Senate is getting 1 big bill, is the fact that if you're not going to have the algorithm with it, what is the point of buying this? Which is why many people say potentially this is going to be a ban. I looked at Terry Haynes, who we spoke to earlier this morning. He's an analyst and really reads the room when it comes to what's going on in Congress. And he says that they're of the view that TikTok issue gets dealt with by year's end. But how? How it gets done, that's what matters in the Senate. Do they give carte blanche power to potentially the president to deal with companies like this? Or is there another avenue they can go on? So there's a lot of questions surrounding it, but it does feel like it's a make or break moment for TikTok, because the House overwhelmingly was for this, and now it's going to the Senate, and they've moved a provision. It was supposed to be 6 months they had to divest or ban. Now it's 1 year long. So basically it gets everyone through the election, and then they can figure out what to do.
It's really interesting how the news cycle has almost been trumped, excuse the pun. $95 billion worth of aid was put through. This was a busy week in Congress. Speaker Johnson, we don't know whether he's going to run into more problems. Explain to me the significance of the $95 billion of aid that was for Taiwan, for Ukraine, and for Israel.
Well, this is going to likely get passed in the Senate, no doubt about that, when it comes to the aid for these American partners. I thought was very interesting is look at the margins of the aid in terms of how they were being passed. Ukraine was the hardest to get through. You had the most amount of no's. So you could still see a lot of individuals, Speaker Johnson's party, a lot of Republicans, conservatives, who are still questioning why the United States is sending money and funding Ukraine, which is why his job potentially is on precarious footing for the rest of the year.
And it was what Marjorie Taylor, I just saw a clip of her, the ultra-conservative. Nothing is being done to secure our border or reduce our debt. I mean, that just identifies and personifies the right hand, the ultra-conservative side of this argument, doesn't it?
Yeah, and the question is whether or not there actually would be a vote to motion to vacate, similar to what the hard right flank of the party did for former Speaker McCarthy. Will Speaker Johnson face the same fate? But after these bills are done, there's really not much for Congress to do. After the Senate signs off on this, it's going to be full-on election mode. You haven't had enough of it yet.
I can't wait to live through this entire election cycle with you. Anne-Marie Hordern, she'll be with us for every twist and turn, taking us through TikTok and the bills on the Hill. Abigail Doolittle is with me. What have we got, Abby, in terms of the sector action?
Well, for the S&P 500 itself, we're looking at the first update in 7 days based on broad gains for most sectors. Tech is the best sector, up 1.2%. NVIDIA, the top leader, after dropping 10% on Friday alone, the worst day since 2020. Microsoft, Apple, Broadcom also higher relative to other sectors trading higher, communication services and discretionary. So those 3 mega cap tech sectors are leading the way today. Materials and energy, the worst sectors. Relative to tech, though, over the last 7 days, it's really taken a bit of a hit. Chips in particular, the stocks, Manus, over the last 7 days, down more than 10%. The worst 7 days, not since October of 2023, but October of 2022. And if you recall, that was a really brutal year of selling. So that's the degree of selling we have been seeing today. A little bit of dip buying. Let's see whether or not it lasts.
Abby, thank you very much. That's the Sector Watch for you. We'll get you up to speed with the events that will set your agenda right here with your trading diary on Bloomberg.
This is Bloomberg. 1 Bloomberg. 2 Bloomberg. 3 Bloomberg. 4 Bloomberg. 5 Bloomberg. 6 Bloomberg. 7 Bloomberg. 8 Bloomberg. 9 Bloomberg. 10 Bloomberg. 11 Bloomberg. 12 Bloomberg. 13 Bloomberg. 14 Bloomberg. 15 Bloomberg. 16 Bloomberg. 17 Bloomberg. 18 Bloomberg. 19 Bloomberg. 20 Bloomberg. 21 Bloomberg. 22 Bloomberg. 23 Bloomberg. 24 Bloomberg. 25 Bloomberg. 26 Bloomberg. 27 Bloomberg. 28 Bloomberg. 29 Bloomberg. 30 Bloomberg. 31 Bloomberg. 32 Bloomberg. 33 Bloomberg. 34 Bloomberg. 35 Bloomberg. 36 Bloomberg. 37 Bloomberg. 38 Bloomberg. 39 Bloomberg. 40 Bloomberg. 41 Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Breathe easy, everybody. NVIDIA's up 4%. That's what's giving a little bit of spirit to these markets. It was down 10%, $200 billion wiped out on Friday. The broader market up 0.4%. All eyes down. Tesla chaos is the talk of the town and on the street. Your trader diary looks a little bit like this. The Treasury kicks off a busy slate of auctions this afternoon. And then it is Tesla, the earnings, and the US PMIs on Tuesday. IBM and Meta are out with their results on Wednesday. Thursday, we get into Alphabet, Microsoft, and then you've got US GDP and another round of jobless claims, taking you through to the final swan song on Friday. UMich Sentiment Survey and the all-importer PCE deflator to wrap up the week. So that is your trading diary. Let's see what Elon Musk delivers tomorrow in terms of the price cutting that he did at the weekend, the risk to the job, and the head count there. That was Countdown to the Open. The team will take you through the rest of your trading day on Bloomberg. Context matters.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
DOJ or other authorities
could face bigger challenges next.
It was going to keep winning World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming on the internet. That would be youtube.com. You head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Alex Steele out on a well-deserved vacation. Manish Krani, believe it or not, sitting in for the next hour. How cool is that? Manish Krani from TV found his way over to the radio studio, so we're going to be chatting with him over the next hour. That's good stuff. We're going to check in with John Butler. Verizon reported some earnings. My check cleared, so hopefully that helped their quarter. We're also going to check in with Nathan Dean, Bloomberg Intelligence. He's down in Washington, D.C. He's going to give us the latest on what's going down there with our good friends down in Congress. But first, let's kick everything off with Lisa Mateo in a Bloomberg Business Flash. Lisa.
You got it, Paul. Market Drivers brought to you by Interactive Brokers. Interactive Brokers charges USD margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. All right, we have stocks advancing as a focus shifts from Middle East tension to company earnings, economic data for clues on where interest rates are headed. So right now we have the Nasdaq up 0.8%, S&P 500 up 0.5%, the Dow up 0.2%. On the earnings front, more than half of the Magnificent Seven companies, including Microsoft, Meta, Alphabet, they will be reporting this week. So I want to check in with right now. We have Microsoft up 0.3%, Meta up nearly 1%, Google up more than 1%. Now we get to the economic data side of things. In the U.S. this week, U.S. GDP, wholesale inventories, initial jobless claims, and we can't forget that rate on personal income and personal spending. To the bond market, the 2-year yield at 4.97%. That's down about a basis point. The 10-year yield at 4.63%, and that's up a basis point. Finally, commodities, we have gold, lower spot gold at $2,336 an ounce, and we have Brent crude at $86 a barrel. That is your Bloomberg Business Flash. Paul and Manis.
Hi, Lisa Mateo. Thank you so much. We appreciate it. Manish Krani sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Manish, thanks so much for making your way here, helping us out for an hour.
Not at all. You're very welcome. Just finished the market open there. And what a joy to start Monday morning with yourself.
Yeah, we got some green on the screen here. We'll take it. You know, we had some softness, obviously, recently in the trading. You know, Tom and I were joking, Manish, about this 5% pullback in the market. So what? Right?
It's a cough.
Yes, thank you.
Really,
Exactly.
it's just a cough, and it's whether you believe that that's a justifiable turn down. You had a lot of rates volatility last week. Look at NVIDIA, dropped by 10% on Friday. That's $200 billion. And there is this view out there that momentum in earnings in the Mag 7 at the top of the tree may well just be fading. And all that does, it adjusts the focus. Right. That's what it does. This is not a crumbling market. It's just an adjustment.
Right. So we've got the early trading up 0.5% on the S&P 500. Also, right smack in the middle of earnings season, Manis. Verizon Communications. I'm a customer of Verizon Wireless. You know,
I think I am as well. Yes, I am Verizon.
I've cut my kids off just about everywhere financially. They're pretty much on their own, with one glaring exception. The cellular telephone bill. They're all still on this whole family plan. I'm carrying all of them. So I haven't figured out how to get rid of them. Maybe that helped with the Verizon's earnings here. John Butler joins us. He covers all things telecom for Bloomberg Intelligence. He's here in the Bloomberg Interactive Broker Studio. He doesn't mail it in like some of his managers do. He comes into the New York office, which we appreciate. John, what did you see from Verizon this quarter?
So, Paul, I thought overall a very solid quarter from Verizon. I mean, one thing that I always look at is pricing, right? Because when they raise prices, which they did on me and you, by the way,
I didn't see that.
It extends across the whole base, their base of 100 million plus subscribers. So pricing was up strongly in the quarter. And I thought overall a solid quarter. I mean, it's interesting because the telecoms throw all these metrics at you, and you can always point to one or two and say they were weak here, they were strong there, you know, and it all comes out in the wash, in my opinion. I sort of I take that 10,000-foot view and I say, how is pricing and how were subscriber net adds? How many net new subscribers did they add? And they're still a share donor. They're still losing a bit of subscribers on the margin, but every quarter they're getting better and better. So on balance, I thought a decent quarter in terms of the trends, and you know, I like where they're headed for the year.
I remember when we used to try to get used to acronyms when we were covering Vodafone and different things in Europe. You know, you got your average revenue per user, but you look at you just switch on your television at home and you got Apple, you've got Netflix, you've got Prime, and you're just consuming so much more at so much more a faster speed. So where are they in terms of pricing differential for that additional bandwidth that I'm going to use more of? It's just a natural evolution of gorging on data.
Well, I'm glad you asked that, Manus, because what Verizon is doing so well is they've come out with a new family of unlimited plans called My Plan, and it allows people to not only buy wireless service, but also the streaming services at a pretty good deal.
So it's finally there's a bundle.
Right, there is a bundle.
Praise!
And you get to control the bundles, so they don't set preset bundles and say you can get plan A, B, or C. You can sort of mix and match and say, I want wireless service and I want Disney, but not Hulu. So you can sort of customize the plan yourself, ergo the name My Plan. And it's resonating really well. Like, I'm really surprised after about a year, they've got a quarter of the base on My Plan. It's very good for them because they're highly profitable plans. And by year end, they hope to have half the base on that My Plan structure, which is big.
You know, I'm looking at the stock here, off about 2.5% today, but up about 5% year to date. This thing's got a 6.5% dividend yield. That's what I'm talking about.
I know.
So I don't know why you can't talk to your good. I saw Tim Cook at Duke recently, and I said, "Can you raise your dividend a little bit?" And he gave me the Heisman. But 6% dividend, 7% dividend yield.
Yeah.
Is that sustainable for these guys?
You know, I think most telecoms know the danger of cutting a dividend, so
Yep.
let's put it that way. But if you look at Verizon stock, you touched on it, it's had a bit of a run here, and so as that stock price goes up, obviously the yield goes down. But, you know, they're very focused on shareholder returns as they mature here. AT&T is the same way, so is T-Mobile. And so in terms of the dividend, I think it's very safe for right now.
You see, you use the word maturity, and that brings a lot of connotations, and one of them is M&A. You remember the most fabled disaster telecoms merger of all time, what was it, AOL, Time Warner. But when you use the word maturity...
Got paid on that, thank you. Yeah, we got paid.
Yeah, good for you.
There you go.
We represent AOL.
We represent, but you know what? But there's the question, is the next iteration in this market some form of M&A, or is it innovation?
So they got asked that in the call, and I thought the answer was very good, which is we have the assets in place right now to execute on the growth plan that we see for the next few years. And I think that's right. But they also have the ability, if they want, to make either tuck-in acquisitions.
He wants dividends. He wants dividends rather than tuck-in acquisitions.
I think they know that investors want that dividend. So in terms of any grand ambitious M&A like we saw with AT&T and Time Warner, I'm not seeing it with Verizon.
What's the competitive landscape these days? Is it just price, 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 price?
It is very tough. At the low end, it's all about price. At the higher end, which is where Verizon plays, it's all about value. What kind of value are you offering with that package? And I think we were talking about Verizon's My Plan, the mix and match. That has high value, and I think it's resonating well with the subscriber base.
All right, very good. John Butler, he is our go-to guy on all things telecom. Verizon putting out some numbers here, decent numbers, stock off a couple of percent today. John Butler covers telecom for Bloomberg Intelligence. We appreciate getting some of his time. Looking at the broader market here, Manus, we have a little bit of a lift here. The S&P's up about 0.5%. The Nasdaq's up about 0.7%. Let's get a look under the hood and see where we're seeing some action here. We do that with our markets correspondent, Abigail Doolittle, who joins us here in studio. Abigail, what are you looking at?
So one of the stocks that really stands out to me, only because it's a continuation of a story, is Salesforce.com or CRM. shares are off the highs, but right now up about 1.5%. Earlier up more than 3% at that point, the best day since February, having to do earlier with a report that talks with Informatica, that software for service company, were cooling, mainly probably over price, and in part because the price was less than what Informatica had been trading for before the speculation around the deal was reported. And then that was confirmed right after the open, Informatica saying that they're not being open to being acquired. Most people are scratching their head as to why Salesforce would have bought or Informatica anyway, only because the CEO Mark Benioff last year had said he wasn't in that market. It really didn't add anything to them. They had already made an acquisition that does the same thing. As for Informatica, well, today it's down 7.2%, and over the last week, since all of this speculation emerged, down more than 15%. So those shareholders are really out in the dark a little bit. But CRM, Salesforce, those investors are happy.
I mean, it just seems like when you get two big companies, you don't walk away from a deal. I mean, when you announce something, you got something.
And maybe the penalty clauses weren't high enough to, to make the two of them sit at the table longer.
Well, I don't think that there was actually. I don't think that. Yeah, it wasn't. It was speculation. Initially, it was a Wall Street Journal report, and then but the main reason that people were speculating that it might not happen anyway. One, there would be the possibility of antitrust regulation. It didn't get that far enough for us to really know that. But Salesforce.com, the rumored price was literally less than what Informatica had been trading for the Friday before it was announced. So it seems as though all players are going home. And Salesforce analysts, for the most part, were, again, really scratching their heads because they already had the software. Mark Benioff had said he wasn't going to do it. Informatica growing slower than Salesforce, so it was unclear what it would have added.
And in terms of the actual, relief in the market, you look at Salesforce this morning, it's up 5.25%. The question is, of course, does this bring anybody else out to play in this space?
That's interesting.
This could just be flying kites in terms of these two, but Salesforce targeting Informatica. But what it does say is that deal action in this quarter, the beginning of the second quarter,
that there's some
the kites are flying.
Yes, to some degree it does. And you could wonder, is that because the environment is healthy and that's a good reason, there's a strong wind to blow the kites? Or is it because, similar to, let's call it 2006, 2007, when you had a lot of big companies go public and other merger activity, they're trying to get it done before the storms come and the kites are down on the ground. So it's unclear right now. The second would clearly be the pessimistic view. But when you think about the Fed and the idea that maybe they're not going to be cutting this year, you have so many geopolitical risks. You have a presidential election that carries a fair amount of uncertainty, even though it seems miles away from here. There is reason to think that this big rally we've had over the last 2 years, that, maybe it could hit a stumbling block or two in the way that it has over the last few weeks.
I think one of the most fascinating stories out there, at least for me, is Tesla. Stocks, off another 2.7% today, hitting a 52-week low. It's just amazing here. I mean, I'm not sure what to make of it. I'm not sure I see. I would certainly have no interest in catching a falling knife here. I don't know where we set the floor here. Do you have any idea?
So as a pattern person, what stands out to me is that Tesla is probably more of a cyclical stock than other stocks, and the fact that it sort of trades up, it does, trades up and down in the range. Now, the more benign range is, I'm trying to figure out, is 200 to 400. It's really 200 to 300. The outside side of the range is 100, which is where we appear to be headed now, and the upside range is 400, just below that. What is it? 412? I can't help. Or 420. 420. Yep. I clearly don't even know that side of the world. But so right now we're below the benign side of the range, going down to the bottom on the slowing growth, the price cuts. The other thing about it is, and this is my own commentary, it's not reflective of Tesla as the company, Elon Musk, the CEO, is a bit of a political figure, and people love to love him and they love to hate him. And right now we're in a hate phase where everybody seems to be bashing him and he's not getting the support. I would say, this is, again, just my opinion. It does not reflect Bloomberg LP in any way, just my opinion. He's willing to say things that other executives, other companies, he's willing to play on the other side of the corporate sandbox. And so at times I feel he gets punished from a sentiment standpoint, and I think some of that is what's happening right now. So that's just the Elon Musk side of it. Now, that could flip on a dime, just as it did between December of 2022 and January of 2023. In terms of the Tesla piece, he does definitely have his work cut out for him in terms of trying to figure out how to keep this thing growing. You know, do they have to redesign bodies? They have to create more of the buzz factor that it used to have, because probably right now everybody who has a Tesla has one or wants one.
Yeah, but we're supposed to be paying for genius. We're supposed to be paying, correct me if I'm wrong, we're supposed to have a premium for genius factor here. Or to quote Kathy Wood, who was with us at Christmas time before she stepped in, we understand the ARC fund has stepped back in and begun to buy Tesla, which is the moat. In other words, how much of a moat is there around the things that Elon Musk creates? And obviously that's just fantasy, because at the moment it's a company in chaos. He in theory wants to reinvigorate by slashing 10, 20% of the workforce. That is GE from 20 years ago. That's not revolutionary. That is not revolutionary.
Yes,
that is not genius.
Well, he's in a little bit of a defense. I mean, and so I actually knew nothing about Elon Musk until maybe a year or two ago. When everybody started hating him, I wanted to know who he was. And I'm actually pretty fascinated by him, and I think that he's pretty interesting. He's in defense right now, and he's an offense guy. So I imagine he's kind of uncomfortable. He needs to figure out a way to, yes, not cut prices, cut workforces, but recreate something, offer something new, so that moat, because I do think he did have him, like in retrospect.
I'm not saying he never had a moat.
Yes, he did before. Now he does not at all. Now, you know, the drawbridges are down, the enemies are coming into the castle, so he needs to figure out a way to reinforce the castle, make it bigger and better than ever. I mean, this is just, again, my opinion, but do something new. I mean, the thing that stands out to me is the cars look the same for the last 10 or 15 years.
That's Matt Miller's pointed that out for a while.
They need to do a body upgrade. These other car companies, they do a body upgrade every 5 years. So there's a reason. Like, have you seen there's some new cars I've seen recently, the BMW 7 Series. It's incredible. It's absolutely
that's what
gorgeous.
I would say. The last time I got off a plane in Zurich, I was picked up in a BMW. I was picked up in a BMW electric car. Beautiful compared to the interior of a Tesla.
Well, that's what he needs.
Stunning.
So now's the time to get some genius car architect or designer to recreate the body and create that wow factor. So in the same way that people used to want the new iPhones, do something like that so people want the new Teslas.
Yep, stock down about 3% today, 50 two-week low. So at $140 here. So we're down 43% year to date. Abigail Doolittle, thanks so much for joining us. Abigail Doolittle, she covers all the markets for us. We appreciate getting a few minutes of her time. And Manus, I'm going to go back to Kevin Tynan, the auto analyst at Bloomberg Intelligence, who told me a long time ago when Tesla was just going crazy as a tech stock, he says at some point, Tesla's going to have to start bending some metal. And that's when the rubber's going to read the road, because it is a tough business, auto manufacturing. And if you can't make a profit at 80 or 90,000 price point, how are you going to make it at 30,000? So just some of the economics of building cars.
You need the charging infrastructure. If the charging infrastructure is not there, then you don't have that Damascene conversion that people like me have to go all electric.
Yep, good stuff. Coming up, Nathan Dean, Bloomberg Intelligence Senior Policy Analyst. He's going to talk to us about this UN House approving a bill totaling $95 billion in aid for Ukraine, Israel, and Taiwan. S&P 500 up 0.4%. This is Bloomberg.
general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
Next week, Representative Marjorie Taylor Greene comes back and she moves forward with her threat. Now, the Democrats have already said, or at least hinted, that they are going to save Speaker Johnson's position. So Speaker Johnson will be a GOP speaker, but it'll be a GOP speaker that has, the support of Democrats, which is not a great position that you want to be in. But ultimately, with the Ukraine, Israel, and Taiwan aid going to the president's desk this week, as we anticipate it will, there's not much else that Speaker Johnson really has to do for the rest of the year. So, just other than those 2 or 3 things, I think he said, okay, we're good. We're just going to move on to the election and see what happens then.
Nathan, good morning, Ismanis. What does the Biden administration need to do to sell this to the U.S. public? We are in full election mode. $95 billion worth of aid across 3 countries. What is the message that they need to sell to make people in the United States of America believe that this was the right thing to do now?
You have an excellent question here because, Congress, as you know, writes the checks, but it's up to President Biden to actually define the strategy and say, how do you use this money and how do you work with our allies on the Ukraine situation? And that's President Biden's biggest challenge now. Now the Congress has done its job, but what happens next? There's not another aid package coming from Congress this year, and I would even argue, depending on how the election plays out, this could be it. There may not be an aid package coming next year. So if I'm President Biden, the one thing that I need to tell the American public is we've gotten $95.3 billion. Most of that's going back to the U.S. industrial base to replenish weapons and munitions and so forth. But here's what the strategy is going to be going forward. Additionally, if Ukraine and Russia remains in conflict going forward over the next few years, I'm the person that you want to be in charge with as opposed to President Trump. And so it's going to be a lot of outreach, both from like you just point out, a lot of outreach to our allies in the region and try and figure out how to resolve the Russia-Ukraine conflict, but also try and sell that to the American people and say, hey, I'm the right person for the job.
Nathan, it seems like Speaker Johnson, I don't know, he looks kind of good here to me. Like, A, he got this big piece of legislation done. B, he's not beholden to literally 5 or 6 representatives who can effectively hold up the whole legislative calendar. I don't know. He looks like pretty good to me all around. Is that the feeling in D.C., or is the feeling in D.C. that his goose is cooked?
No, I think there's really two ways to look at this. One is Speaker Johnson has done what most Republican speakers in the past have done in terms of dealing with the conservative, the very extreme conservative part of their party. And that is, delay, be open, be flexible. Things don't move as quickly as you want, and people get very frustrated by looking at headlines, but ultimately they do move things through, through the Congress. The other thing that happened is Kevin McCarthy went through this process before, and he paid the price. And, had that not happened, a lot of people have said, look, I just don't want to go through this again. So even if I don't agree that Speaker Johnson's the right person for the role, I certainly don't want to go through the exercise of trying to select another speaker. So he has that advantage. But ultimately, Speaker Johnson has been very patient, very flexible, and has worked with both of his allies and former President Donald Trump to ensure that we get to a situation where Ukraine aid passes, the threat to him is fairly low, and we're not seeing posts from President Trump on Truth Social blasting him for that decision.
I mean, what do you think that we will hear from Trump on this, Nathan? Because, as you say, we haven't had the blast of anti-legislation, rhetoric calling for his scalp, etc. Do you think President Trump has other bigger issues to deal with at the moment in terms of litigation?
Yeah, I mean, if you're listening to this in New York City right now, you exactly know what President Trump's main, focus is at the moment. But what I will say is that, we have not seen much reaction from President Trump, but other than over the past few weeks, he has signaled support for this idea of a conditional aid for Ukraine. Now, the way that the law was written is that conditional aid comes in the way of forgivable loans, so a future president can essentially say, we're good at Ukraine, you don't have to pay us back. But ultimately, I think it comes down to just not wanting to offend voters. This is a very popular package with the American people. Also focus on what's going on in New York with his trial at the moment and just see, I just think that he's got other things that he wants to focus on at this point, because if he becomes president 6-7 months from now, it's all a moot point anyway. He's going to decide what the future is.
All right, Nathan, both Manus and Lisa, they have big social media games all over the TikTok thing. This is also part of this legislation here. What's going to happen with TikTok?
So we've been hearing from a lot of clients that have teenagers that are asking this question. And what we're telling is, and this is my colleague Matt Schettenhelm has been working the phones on this for almost every day now, is that you're not going to see TikTok go away before the election. You're not going to see TikTok go away, before the end of the year. Now, when this bill becomes law, the TikTok will have essentially 270 days plus 90 extra wiggle room if the president allows it to divest or to break away the operations. Now, let's just say that doesn't happen, and let's just say that TikTok just holds firm. Then you're going to see a court case. And Matt's piece, which he just put out in the terminal this morning, is a very early look at this about the First Amendment fight, or the First Amendment argument versus the national security argument, is giving the government a 70% chance of victory here. So if you have a teenager who's concerned, this year you may be okay. 2025, they may want to go to Snapchat and Meta, which obviously saw the benefits stock-wise last week when this bill looked like it was going to pass.
I mean, I guess this is, again, for the, you know, the TikTokers out there, it's a huge issue and it's a huge business. It'd be great.
Can I just say, it's the one social media that actually I'm doing. Yes. Ironically, when I came to live in America, everybody said, yeah, do more social media. The one thing I've actually done exceptionally well at on Bloomberg's platform, I should add, not mine, is TikTok. So who would have thought that the TikTok audience want to know about bonds and dollar yen?
Exactly. What does this mean for the trade war? I mean, Nathan, I guess in D.C., what are the folks in D.C., what are they trying to do here? Is it really national security? Is it more politics? What's behind it, do you think?
It's national security. I mean, it's one of those things where, you know, as we're going into an election, a lot of folks have said, you know, there is this. So let me back up. TikTok has spent a lot of time and effort trying to distance themselves from China and to ensure that the data security that they have goes through American personnel, American systems, and so forth like that. But ultimately, you know, being tough on China is good politics. Most people on Capitol Hill do believe that TikTok has a relationship with the Chinese government, and most people do not want to have 170 million Americans and their data having a relationship with the Chinese government. And so ultimately, this was an easy vote for Congress to pass. And TikTok has tried. You know, there's been a lot of folks saying, look, TikTok just put out a piece saying we bring in $24 billion annually to the GDP in the United States. But for the American policymakers who are thinking with the national security lens, that didn't hold up. And the vote will probably most likely become law.
Yeah, this is big stuff for a lot of people out there. It'll be interesting to see how this plays out, particularly when it gets to the courts. Nathan Dean, thanks so much for joining us. Nathan Dean is our senior policy analyst for Bloomberg Intelligence. He's based down in Washington, D.C. He's got his finger on the pulse of what's happening in D.C. Better him than me, I'll tell you that. So, but he is one of the greats down there in D.C. Coming up, we're going to check in with Steve Mann, Bloomberg Intelligence, Global Autos and Industrials Research Analyst. He's going to give us his thoughts on Tesla. Again, seemingly under just a tremendous amount of pressure here. The stock down over 40% year to date, down another couple of percent today, a 52-week low. All types of issues and headwinds here. More price cuts. That's not what you want to see if you're a Tesla shareholder. It is if you're going out there to buy a Tesla. Maybe Michael Barr is thinking about a Tesla. But a charge won't even get Michael Barr from his house to Bloomberg. That's how far away he lives. S&P 500, we are up 0.3%. With our news in New York City, here is the aforementioned Michael Barr.
Thank you very much, Paul Manis. Lisa, jury in Manhattan hearing opening statements right now in former President Donald Trump's criminal trial. According to the prosecution, the case is about a criminal conspiracy. Trump is accused of falsifying business records to conceal a hush money deal with an adult film actress ahead of the 2016 election. The former president arriving at court in Lower Manhattan, addressing reporters before heading into the courtroom.
I'm here instead of being able to be in Pennsylvania and Georgia and lots of other places campaigning, and it's very unfair.
There has already been a ruling in the case. Judge Juan Richan says he will not allow the infamous Access Hollywood tape to be played during trial. Meanwhile, the $175 million bond that Donald Trump obtained to protect his assets while he appeals a New York civil fraud judgment will get a closer inspection in court today. It comes after State Attorney General Letitia James voiced concerns. Former federal prosecutor Lori Levinson.
Now the Attorney General's arguing that bond and who put it up and how it was put together does not sufficiently secure the money that would be owed by Trump if he loses his appeal.
Former federal prosecutor Lori Levinson. The Supreme Court agreed today to take up a Biden administration appeal over the regulation of difficult-to-trace ghost guns that had been struck down by lower courts. Today marks the 54th anniversary of Earth Day. President Biden will focus on solar energy with an event in Virginia and also make an announcement about new climate-focused jobs. Biden will announce new actions to support his American Climate Corps program, including news that Americans can apply for nearly 2,000 positions across the nation. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got green on the screen as the focus shifts from tension in the Middle East to earnings. Tech earnings in the spotlight this week. Speaking of big tech, we have UBS. They cut its view on the so-called big six tech stocks to neutral from overweight. So I want to check in with them now. We have Apple up about 0.2%, Amazon up 0.3%, Alphabet nearly 0.5%, Meta, though, down 1%. We have Microsoft down 0.2%, NVIDIA up 2%. Over to NASDAQ right now, it's up 0.3%. Same for the S&P 500, the Dow up 0.2%. The 2-year yield at 4.96%, that's down 2 basis points. The 10-year yield at 4.63%, and that's up a basis point. Finally, to commodities we go. We have spot gold lower at $2,341 an ounce, Brent crude at $86 a barrel. That is your Bloomberg Business Flash. Paul and Minus.
All right, Lisa Mateo, thank you so much. We appreciate that. Managed Cranny, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so just head over to youtube.com and search Bloomberg Podcast. More news, Manus, out of our good friends at Tesla. Tesla cuts roughly 40-person growth content advertising team. So they're limiting the marketing team as part of those layoffs. That's according to people familiar with the matter here. Stock off 4% today, 52-week low, down 43% year to date. Let's check in with Steve Mann. He's a global autos analyst for Bloomberg Intelligence. He joins us from the Princeton campus, and I mean campus down there. It is beautiful down there in Princeton. That's kind of where we got a lot of the Bloomberg Intelligence folks housed down there. Steve, this is brutal here. Let's start with something basic, which is really the fundamental issue here, which is pricing. I believed Mr. Musk cut prices again. Does he, if he wakes up on the wrong side of the bed, does he cut prices? What's going on with the pricing at Tesla these days?
There's a lot of things going on at Tesla right now. Brutal is probably not. That's mildly calling it. We always thought that they will have to reverse prices. We're not sure why. Early in the year they increased prices. But prices have been dropped in the U.S. Prices over the weekend has been dropped in China. China is a quite different market. It's hyper competitive. Everybody's cutting prices, especially BYD early in the year and late last year. So we're not surprised they're going to cut prices. The question is, where are the earnings going to be? And there's going to be a lot of questions that Elon Musk has to answer tomorrow at their earnings call.
Yeah, Wedbush Securities were with me a couple of weeks ago, and they said it's a Hurricane 5 storm coming towards them. That's gone from a Cinderella story to that. But if you look at BYD, if you look at Lee, and you look at Tesla, they're all cutting prices. So is this the bottom of that cycle? Has Tesla got the capacity to weather a price-cutting storm in China?
That's a good question. I don't think it's the end of it. We're actually seeing second quarter sales to be, probably the same as what we saw in the first quarter. And remember, first quarter, Tesla actually, and the industry itself, actually show slower growth and even some declines for certain automakers like Tesla. So, second quarter is not going to be pretty as well. And I think Tesla, fortunately for them, they are still the only profitable EV maker in the industry right now. They have about 17% gross margin compared to Ford and GM. They're at high single digit. So they do have some room to give, and I think part of it is really they're really hoping, Tesla is really hoping to drive more volume, generate more cash. And one of the things that they want to get to sooner rather than later is really to monetize that robo-taxi, all the investment they've made in AI and autonomous vehicles.
Gross margin of 70%, is that just on the manufacturing side, or is that with the credits and so on and so forth? Because my question is, if they start cutting prices, are they going to sacrifice unit profitability?
Yeah, the 17%.
17, thank you.
17 is on the automotive side. Look, we're hoping they don't cut more prices because 17% is not as good as the mid 20% they were getting last year and the year before. and cutting prices is not the solution. The industry does not need to be in that spiral of cutting tit for tat price cuts. It's going to hurt everyone, and at the same time, it's going to hurt, the GMs and Ford, because it doesn't really make it, feasible even for them to roll out a cheaper model down the road. So, what we're trying to do is create greater adoption in the EV market, in the EV industry for every consumer, and cutting prices is going to, weed out a lot of the competition that are actually trying to introduce a more affordable model for the market, for the greater market.
Steve, I mean, we can debate adoptability in China and the United States of America forever. I mean, the infrastructure is, one could coin a phrase, probably not there. Again, going back to a Wedbush note delivered in my inbox this morning by Dan Ives, which is, it comes down to delivering a Model 2 in the next 12 to 18 months to deliver a second wave of growth. If they don't deliver a new Model 2, that growth will not come. And robo-taxis would be a tragic gamble, in our opinion, as full autonomy we do not see until 2030. This comes down to innovation in Model 2 at the base, doesn't it?
Yeah, Model 2 is important. I think what the industry is looking for and what investors are looking for is they're looking for more affordable models for consumers, so that the penetration rate, so the addressable market for EV actually it's going to be greater than what it is today. Now, like I said earlier, Tesla it has been aggressive, probably the most aggressive in cutting EV prices. And they've redesigned a vehicle that they can manufacture at a lower cost than it is today. So, they could launch a Model 2. The other option, I don't think the market has really talked about is, the price cutting will allow them the cost cutting will probably allow them to cut prices even further. It wouldn't be a surprise down the road that they're going to offer the Model 3 below $30,000. If they can manage that cost wisely.
Hey, Steve, after the close tomorrow, Tesla will report numbers. They have a conference call 5:30 p.m. Wall Street time. What does Elon Musk need? What message does he need to get across to kind of, shore up this stock price here?
Well, as you know, the stock price is, mostly driven by the anticipation of robotaxi, of autonomous vehicle, of AI. I think what he really needs to come out and tell people, give certain milestones for the investors to follow, to understand, how he's taking that company forward into, into the next decade. Right? How is robotaxi is going to generate the revenue and the profit that he's so much been advocating for. So, automotive business, we all know it's a small part. It's in terms of valuation. But I think Elon Musk and the company really needs to come out to make the investor feel comfortable that he is still on track and there is a light at the end of the tunnel, sooner rather than later.
Is there a sense that he's focused enough on this company here? Is there still that concern that he's spread too thin, do you think?
I don't think so. I think, he's one person. I mean, he's done a lot with SpaceX. He's done a lot with Tesla, obviously, and I think even though there's been some departure, I think he still has a very, very strong team behind him. He's still hiring a lot for the AI, for the autonomous vehicle business. So I'm not too concerned at the moment. I think communication is key for the company in the next, tomorrow, in the next few weeks.
Yep.
And through August 8th, when he actually reveals his robotaxi.
Oh, okay. All right. Well, I'm going to listen to this call tomorrow. So that'll be interesting. I think a lot of people are going to pay attention to that call. Steve, thanks so much for joining us. Steve Mann, Global Autos and Industrials Research Analyst for Bloomberg Intelligence, joining us from Princeton, New Jersey, via Zoom. And here it's, as Dan Ives of Wedbush said, this is a critical, maybe the most important conference call for Elon Musk here, because there is a whole host of headwinds for this company.
It's about reinstilling confidence.
Yep.
It's confidence in genius. I never said the genius had left.
Right. No, exactly right. So we'll see that Tesla again. 52-week low here today, off about 45%. Just year to date, significant loss of value there. We're going to have more coming up. This is Bloomberg.
company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. It is a busy week for big tech earnings. For the so-called Magnificent Seven report first quarter results, Tesla, Meta Platforms, Google parent Alphabet, and Microsoft. Mandeep Singh covers tech for Bloomberg Intelligence.
Good enough earnings is not going to do this earnings season. You need to have spectacular earnings. NVIDIA has delivered that for the last two times. This time around, it's not going to be, I think, NVIDIA. It will probably be Microsoft.
Well, why Microsoft? Well, Singh says NVIDIA may be churning out the bulk of the AI chips, but Microsoft is a company that's deploying them in the cloud. Right now, we have Microsoft down about 0.5%, NVIDIA up more than 1%. Tesla opens its books tomorrow. It comes after cutting model prices over the weekend across China and Europe, as well as its driver assistance software in the U.S. Bloomberg also reporting Tesla slashed a newly formed marketing team as part of company-wide layoffs. Bloomberg's Craig Trudell says Elon Musk's moves are a bit troubling.
There's really concern about this idea that he's going so far as to put aside plans for a $25,000 car and sort of, put it all on robo-taxis, which he's been talking about for years, but which, Tesla really hasn't made a whole lot of progress with standing up the infrastructure it needs to do that.
And Tesla shares down more than 4%. To earnings we go. Verizon beat analyst estimates for profit while boosting wireless service revenue, even as it lost more retail phone customers than expected. Verizon now down 2%. Informatica is setting the record straight. The company said it's not engaged in takeover talks following reports that discussions with Salesforce had cooled. Right now, Informatica down 10%. We have Salesforce down just a fraction. And Kroger and Albertsons have agreed to divest more stores to C&S wholesale grocers to make the merger more appealing to antitrust authorities. That is your company news at this hour. I'm Lisa Mateo.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Now we got stocks coming off of the intraday highs. The S&P 500 up about 0.2%. NASDAQ pretty much just up about 12 points here. Bitcoin, that's where the action is, up 2.6% today, 66,300 on the cryptocurrency. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Manus, and Lisa. Donald Trump is in a New York City court today as opening statements just started in his criminal hush money trial. Prosecutors said in its opening statement that Trump orchestrated a criminal scheme to corrupt the 2016 presidential election. Just down the street, Trump's attorneys will be busy inside another courtroom to defend the $175 million bond in the former president's civil fraud case. New York Attorney General Letitia James is urging the judge to reject the bond and give Trump a week to find a new one. Before entering the courtroom for his hush money trial, Trump spoke to reporters about the civil fraud case.
The money was put up, it's $175 million. And I don't think she's complaining about me for the first time ever. She's complaining about the company. But why would she be doing that when I put up the money?
James is concerned the company behind the bond, Knight Specialty Insurance Company, doesn't have enough collateral to pay the bond if Trump's appeal fails. The Senate plans to hold its first votes tomorrow on the $95 billion aid package for Ukraine, Israel, and Taiwan. Over the weekend, more Republicans voted against Ukraine aid than for it, and at least 3 hardliners have threatened to try to oust Speaker Mike Johnson over it. However, Bloomberg's Laura Davison reports there may be little appetite for another speakership fight on Capitol Hill.